Welcome to CapitalHQ, where exclusive access to the private market and curated deal flows await you. Dive into a world of possibilities, from innovative startups and scale-ups to lucrative IPOs and high-yield credit opportunities, all at your fingertips. Gain unparalleled investment insights from some of the leading minds in the industry. Stay ahead with our expert perspectives from around the globe. Connect and network with fellow investors of similar caliber. Join our exclusive in-person and online functions to share, learn, and grow together. And the best part? Joining CapitalHQ is completely free for investors. Become part of our proprietary network of over 33,000 investors today. Discover, invest, and network with CapitalHQ, your gateway to the future of investment.
Hi, ladies and gentlemen, and welcome. My name is Steve Torsa. I'm the founder of Wholesale Investor and CapitalHQ. I'd like to welcome you all to our CapitalHQ online investment showcase. So today, we've got an incredible lineup for you. First up, we've got John Sharp from Hatcher Plus. Now, we've got a partnership with Hatcher Plus with our HNWI ANZ fund. And the reason for that is I was absolutely blown away by John the first time I come across him and have been to date since. What they did as a company was they effectively took a data and AI-driven approach to the way in which venture capital is done. And they went and looked at what makes the most successful returns for venture and what is the approach they should take. What they effectively landed on was a systematic approach to venture investing that will blow your mind when you get the opportunity to understand it. So you'll really enjoy that keynote from John. Now, on the company side, we've got an incredible range of companies that are presenting today. It's an incredible session we've got lined up for you today. Obviously, inside our CapitalHQ platform, all the companies are featured. You can message the CEOs as they're presenting. You can request access to their deal rooms. And of course, if you're watching this sort of after the event as well, take your time. You can click on the individual sessions in the actual agenda item. We've made it super easy for you to get access to what you want. The most important thing about today is be active, be engaged, connect with the companies that interest you. And also, as I always say, whilst you're watching the companies present, they may not be directly relevant for you, but they may be relevant for someone in your ecosystem. So not only look at the opportunities from your own lens, but also from the perspective of how they could be relevant for other investors in your network. So on that note, enjoy the CapitalHQ online investment showcase, and I look forward to seeing you at the end.
Hi everyone, and welcome to the keynote address. Thank you very much, Steve and Wholesale Investor, for inviting me once again to be part of one of your fabulous events. I really appreciate it. Today I thought it'd be a really great idea to delve into some of the trends that we're seeing out there, and specifically what I'm going to talk about today is the new 60-40. So of course, for those of you in the audience, we are doing this pitch with a lot of Australians in the audience. Of course, we're all familiar with the old 60-40, which of course is 60% stocks, 40% bonds, our portfolio strategy. It's our informed opinion that we think this is going away. And before I go into why we think that, let me give you a bit of background on myself. I've had a number of different careers. I've been lucky enough to work in several different industries. There's super fun stuff in space, in cybersecurity, and now in venture capital. In this most recent life, I've been working with Hatcher, and we've done about 339 investments to date. We're a top 20 data-driven VC on a global basis. We're the only non-European, non-US VC on that list. And one of the reasons that we've been awarded or honored with that is that we've created a lot of tech that we use as part of our selection process, but also our portfolio management process. And we work closely with folks like Wholesale Investor to pull their deals into our system, let our investors see that, and vice versa. So it's a very nice symbiotic relationship that we have with WI. So let's look at briefly at the current sort of idea behind portfolios for the last, I think you could basically say 100 years, because really most of the data goes back into the 1920s when it's quoted. In fact, you can see on the right-hand side here that the reason that a 60% stock, 40% bond portfolio has been recommended is that it's returned basically 10% a year for all of that time. Best year, interestingly, was 1933, 2 years after the worst year, which was 1931. And I think those of us that were very recently looking on at the 2007 to 2009 sort of period or recognize something in that. In 2011, we had our biggest crop of unicorns that we'd had in a long, long time, 4 years after one of the worst financial periods in history. So yeah, these things there is a history there of very bad cycles being rather quickly replaced with very good ones. But in any case, that's beyond the scope of what we're talking about today. All I wanted to make the point is that we've been doing 60-40 for 100 years, and no one's really questioned that until now. And what we're seeing is that there's a new 60-40 that's coming, and the 60 is now your old 60-40. It's stocks and bonds. That's 60%, if that even. And the new 40% is PE, venture, and crypto. And we're going to delve into some of the reasons for that. But this is something that it's not just conjecture for us. This is something you're going to hear whenever you attend a wealth management event or whenever you hear an economist speaking. They're talking about a really significant change in how people are allocating capital, and there's some good reasons for that. So yes, there's a new 60-40. Why is it happening? We're going to delve into this, and we're also going to delve into what does this mean for you as investors. So let's start with the youngest guys in the room, the millennials. So why are millennials adopting this change in strategy around their portfolio? The main reason for that is that they're motivated to get wealthy pretty quickly. And there's a couple of reasons there. They have really high personal debt relative to folks that are older. They tend to have 5.4x more credit card debt, 2.4x more auto loan debt, 1.7x more student loan debt. If you're a parent of a millennial, then you know that they spend twice as much as you do, and they tend to live a more extravagant lifestyle than we did when we were younger. So they're attracted by the new 60-40 split because they know that VC investments in crypto are probably going to get them a bigger hit or a bigger bang for their buck than traditional investments. They don't want to wait around for 10% on average a year. They want to go after those 20% average IRRs. It's a Cambridge Associates number, by the way, for VC and PE. And they also want to go after the crypto returns. And who hasn't sat next to someone on a Friday night and heard them say that I just made 10,000% in the last 2 years? It's frustrating, it's annoying, but it happens to all of us. And I'm not one of those people, by the way. I do have a little bit of crypto, but I'm not one of those guys who was smart enough to get in like 2012. I did try, but that's a story for another day. So that's the millennials. Let's look at why institutions are now taking a serious look at PE and venture in particular. And the model for this is typically called the Swensen effect after David Swensen, now unfortunately passed away. But when he took over as CIO at Yale, he transformed their allocation policy. Now, this is not dry reading, guys. This is fundamental and super interesting. He basically took a really sort of boring old approach and turned it on its head and started investing massively in private equity and venture, and ended up with 15.8% returns annualized over a period of many, many years, and just completely transformed how institutions view PE and venture. So instos used to basically maybe do 2 or 3% allocation, and they've completely transformed this based on what is now called the endowment model after David Swensen. And I was just at a UBS event a few months ago where their head of wealth recommended the endowment model and commented that they were seeing above 20% allocations to PE and venture in many of the family office portfolios. This is UBS. They're the world's largest wealth manager. When they're sharing numbers like that, I think they're reliable numbers, and they definitely show you that there's a trend going on. David Swensen deserves a lot of credit for this trend. So what else is driving this? There's a $10 trillion transfer going on. I mean, look, there's $145 trillion in assets that are sitting out there managed by asset managers. Some of those asset managers are you guys, the 600,000 self-managed super funds in Australia. It's estimated that a minimum of $10 trillion is going to pass between generations over the next 20 years. And there's some estimates out there that are crazy much higher than that. I just chose 10 trillion because it was one of the lower estimates. But yeah, there's a lot of money that's going to go from grandpa to dad to the kids over the next few years. So where's that money going to go? It's not going to go down the throat of an old 60-40 portfolio. It's almost definitely going to go into VC, PE, and crypto. I was recently in Amsterdam. I met with the head of a large family office there, and he gave his 16-year-old $50,000 to invest. And I said, how did that go? And he said, well, in 6 months, he turned it into $500,000. I said, that's amazing. I said, crypto? And he said, yeah, crypto. So this is obviously the first choice of a 16-year-old. It was the first investment of my 14-year-old. So the younger the family office principal, the younger the CIO, the more likely they're going to have a crypto stash. But that has just been made far more likely now, and we'll talk about this in a second, by the fact that there's now ETFs coming out on this security, which is going to radically transform that. And a lot of people think it's going to drive cryptocurrencies much higher. I would agree with that. I think it stands to reason that once you have large institutions backing it, just like we talked about with venture just now, that's going to have an effect. So what are the other game changers here? And what are the other reasons that people are doing this? Well, one of the other reasons people are doing this is the most amazing time to be investing in technology. And I'm not saying this is some venture capital guy that wants you to invest in my fund. I am actually saying it because of that, but I'm all saying it because this is a truly amazing time. I mean, if you see what's going on in biotech and life sciences now, and the kind of stuff they're coming out with, they're curing previously incurable forms of cancer. They're extending our lives in so many ways. It's crazy. They're curing things like diabetes, which affect up to 15% of the population in some areas. And they're extending our lives. In fact, I saw a presentation recently where one of the slides in the presentation made the point that in Japan, they sell more adult diapers than baby diapers, or adult nappies and baby nappies for Australians. And that's an interesting statistic, and that won't just be Japan. That's going to be Korea, China, Europe, pretty much the rest of the world. As your population ages and young people decide they don't really want to clean up after old people, that's not their chosen life vocation, we're going to require millions of robots, and Japan is already well ahead in this area. If you're ever in Tokyo and you can swing it, go by the University of Tokyo's innovation division, and you'll see some most amazing the things that they're building there in terms of robotics. We're going to need lots of robotics to do the dirty work. We're also going to need lots of robots that are powered by AI to just hold people's hands and provide companionship. And I know that sounds probably a bit weird now, but it's happening. And any kind of companionship is better than being lonely. AI does a fantastic job at helping people that are facing mental health problems. We just invested in a fantastic mental health app in Indonesia. In Indonesia, there's something like 6 psychologists for every 100,000 people. And so having an AI-powered mental health app is really game-changing in that environment. But look, of course, AI is going to transform music. It's going to write screenplays. It's going to transform everything out there in the environment. And the people that come up with the best versions of that, and we think we've invested in a few of those, are going to make a ton of money out of those apps and those technologies. Crypto, it's game-changing. I mean, it's a cross-border currency that has some very interesting characteristics that are similar in some respects to precious metals. It's a fascinating area. Some people love it, some people hate it. It doesn't matter. It's game-changing. I recently asked my 14-year-old if he is interested in going to Mars. He's like, why the hell would I want to go to Mars? And he makes a very interesting point. I mean, he has so much fun in the online world that we've created as an alternative to Earth already. So when you think about it, there's really sort of 3 places we can go to. We can go to Mars, we can go to Earth, we can actually go outside like we used to when we were kids, or we can go and inhabit this online world. And the online world is pretty darn amazing. I know there's a lot of people that say stuff about the online world and how much screen time that kids have, but honestly, if I was a kid now, I'd be like 24/7 online, just because some of the stuff you can do there is really remarkable. Now, we're all aware of the next stuff, but you have to mention it. Artificial general intelligence, we use a lot of AI at Hatcher. We've been using it for 5-6 years, and 3, 4, 5 years ago it was a bit of a joke, and now it's really amazing what the AI can do. It's phenomenal, and I predict within 3 or 4 years the only business plans we will see will be business plans written with the assistance of AI, and then the trick is going to be to figure out how much of the founder is in the business plan versus how much of it was created on OpenAI. Climate, I've done a lot of work in climate and carbon. I was brought into that space by my cousin, who's based in Melbourne, runs a big climate and environmental focused fund there. So he's taught me a lot in that area. It's going to be a massive area for investment. Water is going to be a really big thing coming up. We just as co-sponsored a climate summit, or a climate cohort rather, with Brink, and we're just doing a water cohort with R3I Ventures at the moment. Esports, I just talked about online and how fabulous that is. Space, EVs, post-oil energy. Just take a minute and think about how things get transformed when we start running out of oil, and where that energy comes from and how much money can be made there. The same with decarbonized infrastructure. Some fantastic companies coming up. I just saw a great New Zealand company called Neocrete that's building, that's making concrete that uses 40 to 50% less carbon when it's making it, and it's much stronger. It lasts much longer. They're going to make a ton of money as all of the bridges, all of the roads, all of the runways in the world come up for replacement, which is coming up in the next 10 to 30 years. So there's a ton of money to be made in each of these spaces, and of course, many more. So why do we do the new 60-40? The reason that all of us invest is because we want to get wealthy or wealthier. Why do millennials do it? Well, for millennials, they need to get something more than the salary they're getting. They need the ability to invest. And just a quick side note here, this is why I get so frustrated by legislation or regulatory moves that attempt to push up the way that a sophisticated investor or a wholesale investor, in Aussie terminology, gets rated, because I just think it's an awful idea to push younger people out of away from the ability to invest in startups and things that can really significantly increase their chances of getting wealthy. And look, the need to get wealthy is they have high personal debt, as we've already talked about, but also their costs going forward are significant. Buying a house is a much different proposition than it was even 20 years ago. Having more than one kid has become so out of reach for so many people now in Korea, in Japan, in Singapore, in many parts of the world, that most people are having one. It's just too expensive. So if you want to have more kids, then you need to be a wealthy person. I actually have a side hustle that's a startup, and 2 of my co-founders in that have 8 kids each. Why? Because they're wealthy people. So they're able to have a large number of kids and carry that cost. The other reason you need to be healthy is you're going to face a much larger tax burden in the coming generation as a millennial than we previously faced. We cannot go on with the unsustainable level that we are now. We are going to face more taxes. Having a second passport is probably a good thing to think about because of that. My son has 3 passports. God bless him. He's going to have many choices in his life. And my daughter has 2. My son was lucky enough to be born in the US, so he has that extra one. Sustainability of food and water is going to require location flexibility, which again is an expensive proposition. And then you've got the other stuff that's coming up. So if you're a smart guy now, if you're really good at what you do now, you may have 10 really good years as a programmer. But after that, you may find some challenges with AI coming up and stealing your job. And that's for programming, that's for psychology, that's for some of the most deeply difficult jobs to do. AI turns out is really, really good at those jobs. So that's the new 60-40. We think it's a potential faster path to wealth. Capital is abundant right now, but the other reason people are going in the direction of venture PE and crypto is stocks and commercial real estate are looking pretty toppy. Commercial real estate has a bunch of other challenges in that no one in San Francisco turns up into San Francisco on Monday or Friday anymore, and sometimes they don't even turn up on Tuesday, Wednesday, and Thursday. So if you're a sandwich shop in downtown San Francisco, you're in a pretty crappy world right now because you just don't have enough customers coming into town. The other problems are inflation could reemerge. Your stocks and bonds aren't typically a great hedge against that. But if you're earning 20% from your alternative investments, that's a pretty good thing to look at. The other reason 60-40 is something you can do now is because there are all these ways to reach opportunities. So CapitalHQ from Steve, Hatcher Fast from us, these are places where you can go and source for deals. We're just about to release the Hatcher Top 100. You can log in, you can find the top 100 startups in the world as judged by our AI engine. Steve, maybe we should talk about putting that up on CapIQ as well, and we can share some deals there. So the other reason that 60-40 is appealing is that millennials, yes, they've got a lot of debt. Yes, they're facing some issues with potential future tax burden, but they also kind of know that they've been more potentially de-risked than anyone in previous generations because their parents are wealthier than previous generations. So buying into crypto startups and things, if they have a few reversals on that, it's not as risky as it would have been for people maybe 20 or 30 or 50 years ago when it would have been consequentially more risky. Right now, there's a little bit of de-risking going on there because they know that $10 trillion I talked about earlier is kind of coming their way sometime soon. So that's another reason why it's a lot easier to look at doing the new 60-40 instead of what it used to be doing the old 60-40. So let's finish on how we can participate. The crypto world is now accessible by ETFs. You can just buy from someone that you've heard about or from a name brand firm that you trust. As I just mentioned, VC opportunities are easier to find and research than ever before. You can use AI to research them. You can use various platforms that are out there to look at their deal streams and invest. There's another thing that's changing as well. It used to be founders would very much gravitate towards VC firms, but what they've since discovered is that actually family offices have a lot of DNA, a lot of entrepreneurial DNA. And so if you have an intelligent family office, the capital could be more patient capital. The guys running that capital might actually be smarter than some of the VCs that you meet. So there's a lot of capability here that the family offices bring to the table that is very competitive with what the VCs can bring to the table. Lastly, funds, trusts, SPVs are easier to set up than ever before. If you want to set those up, you can set them up on our platform or other platforms in days. Government incentives may be available to you if you set up the right structure in Australia. So it's easier than ever before to go from being an angel investor to being a VC and to enjoying that whole process. So hopefully that's a brief and helpful overview of what we see coming in the new world of portfolio weighting and how some of the investors that we're interfacing with are thinking about that new world and where they're putting their money. Steve, team, thank you again for the invite to be part of this of this great event, and thank you all for listening.
Hi, thanks for tuning in today. I'm here to talk to you about Themis, a multi-award-winning digital financial crime platform. Essentially, we make it so easy for you to do due diligence on your clients, suppliers, third parties, and investments. My name is Dickon Johnson. I'm the founder and CEO of Themis. I'm also a former bank CEO, so someone who's spent most of my career using, buying, and implementing competitor compliance systems. So what is the solution? Themis provides a single view of financial crime risk in one platform. So through our platform, you can search for any individual or any company anywhere in the world to find out if they have a criminal record or any other form of financial crime related red flag, be that allegations of malpractice such as bribery, corruption, fraud, through to political exposure, sanctions, corporate actions, regulatory actions, insolvency issues, and more. Part of the beauty of the system is how easy it is to do your due diligence on any given client, supplier, third party, or investor. And you're not just doing due diligence on any one individual or company, but at the click of a button, you're able to also automatically pop out their entire risk map of associated counterparties and connections. Why is that so important? Well, 99% of the people we deal with will be nice, law-abiding, legitimate citizens. But the 1% who are criminally minded or part of an organized crime group will be deliberately obfuscating their illicit activities through a myriad or a web of front partners, front companies, offshore companies, SPVs. Why is this so important? Well, it may surprise some of you to learn that organized crime is one of the largest and most profitable trades in the world today. In fact, latest UNODC figures suggest that over 2.7% of global GDP is lost every year to money laundering and other forms of financial crime. That's trillions and trillions of pounds that is lining the pockets of criminals and organized crime groups who are very deliberately exploiting the most vulnerable members of our society, who are very deliberately exploiting the natural world and attacking our businesses. Now, as a B Corp and as a purpose-driven business, we care deeply and passionately about this. And our whole mission as a business is to reduce the global impacts of financial crime, to reduce the very real harm and damage being caused to people, businesses, and the environment. How do we do that? If we can make it so easy for everybody to do due diligence every day as part of their working lives and their home lives, then it becomes almost impossible for criminals to operate in the shadow economy without being detected and reported into law enforcement. Many of our clients use us to protect themselves from any unwanted or unknown links to criminality or organized crime, and also to do more of the right type of business. As family offices and as professional investors, I am 100% sure that you will care deeply about the financial and reputational risks that you may be exposed to if you don't do this level of due diligence or if this goes wrong. As professional investors, you should all, in my humble opinion, be using Themis to kick the tires of any potential investment that you make, really to make sure that there are no skeletons in the closet that are going to come and burn you in 5 years' time. So how is Themis doing as a business? So far, we've generated over 2.8 million in sales with impressive year-on-year growth. Last year, in fact, we saw a 95% year-on-year growth on prior year. And this year, a really important date for me, on the 9th of May, we crossed our full year revenue from last year. So what does that mean? That means everything we do from here on out for the rest of the year is really good year-on-year revenue growth. We have a fantastic and growing client book of well-known international names across both the private and public sectors. And we're doing this raise now to help us scale up following a number of very, very exciting new mandates won. One of these gives us first mover advantage over a whole sector, and the other over a whole country as part of an official e-government platform or national rollout. So clearly hugely exciting and transformational times for Themis, but we do need to execute well. And given the volume of client accounts expected, we need to staff up. So we need more sellers and we need more account managers so that we can manage and look after those clients to the same excellent client standards that we hold dear to our heart now. So hence we're doing this raise. We are already 2.79 million into a 3 to 5 million target raise with some room to overfund as well. The faster we can close, to be frank, the faster we can hire and the faster we can realize those revenue opportunities. So we are offering a 2-year convertible loan note with a 9% PIK. So it means after 2 years, you would be able to either withdraw your initial capital and the 18% interest earned, or, and we hope you would do this, convert both into equity. And we'd offer that at a 20% discount to our future round price, so our Series A round price. We've also capped that round at 29.6 million in terms of our valuation. Now, if we execute this scale-up opportunity and these specific mandates really well, the reality is we should far exceed that valuation. So there's another potential upside there for investors who come in now. Based on all of this, we're forecasting an ROI of circa 24.9 times over a 3-year period. So I hope that's given you a useful introduction to Themis and the exciting opportunity we have ahead of us here. We would love to welcome you onto our cap table, and you will be in very, very good company. If anyone has any further questions, I'm very happy to jump on a call. I'd love to meet you, answer any questions you have. We do also have a full data room, so I'm very happy to provide as much information as possible to make your decision as easy as possible. Thank you so much for listening, and really look forward to being in touch.
An experienced property professional told me a story that 20 years ago, around 2004, he was interested in buying a rundown commercial building. It's distressed, unoccupied, needs a lot of work, but presents a great investment opportunity because of it. So like a good property professional, he went to have a look, and his bank manager went with him. And that same day, his bank manager gave him a term sheet for a loan that his bank would provide to him in order to help him purchase the property. Now, fast forward 20 years and the environment could not be more different.
I left UBS in 2016 looking to invest my own capital, looking for safe and good returns. Coming from the world of interest rate trading and markets, very exciting and volatile, I wanted the opposite, boring, predictable, safe returns for my own capital, and stumbled into this product. Scott, having been a broker and having been involved in various bridge loans in the past, introduced Andy, and Andy introduced me. We did one loan together, and then we did another loan, and it went from there.
Before we knew it, we had 10 deals, and over the last 7 years, we've continued to grow at a steady pace. I had a certain skill set, and Andy and Steve have another skill set, and it's a good partnership.
We arrived to the product as investors ourselves, and that was initially our only interest in it. There were property professionals out there that needed support, that could provide excellent security, that had great experience, that weren't getting their needs met by the banking industry.
Property finance is probably the oldest form of finance in the world. It's a great example of how wealth is created. Someone can build a house, but he hasn't got the money to buy the bricks. He can borrow that and build a house. The lender gets a bit of profit, he gets a bit of profit, the world gets a house. But our investment product is a 9% secured bond. Buy the bond, you get 9% fixed return paid to you in monthly installments or quarterly on the stock exchange version, and that's it.
I've been with the company 2.5 years. Our clients are property investors and developers that are looking to build a portfolio, and that's their full-time job. They trust me and I trust them to know that they're going to get on and do what they say they're going to do. Equally, they know if they say to me, I need this money by this time, they know if I say they can have it, then they'll have it.
The banks don't provide the funds either fast enough or they don't provide it at all. For instance, if you buy a property and there's no kitchen sink, you will not get a loan from the bank. No buy-to-let, no mortgage, nothing, forget it. So we bridge them from the unmortgageable to the mortgageable.
Any project, any loan starts with a conversation with the customer. So we're looking very closely at the security, what are they buying or refinancing. We're looking very closely at the exit strategy, and we're looking very closely at the individual and whether they are appropriate for that project. So then we might offer terms in principle, and if the customer wishes to proceed, then a due diligence process begins.
Real estate's a very relationship-orientated business. There's many cases where people have come to us and they've needed a loan in very short order, and we've been able to perform for them, often because we've got existing relationships with them and we're able to move quite quickly.
About 50% of our loans are from repeat borrowers, so we must have a good reputation. I think our fastest loan is under 24 hours, about 23, for a client that really needed to execute quickly. And we looked at the deal and liked it, and we knew the person. We're small enough and nimble enough that we can do that.
There are reams of due diligence that is carried out on us, particularly by our banking institutions, which is then shared openly with all our investors.
We love that the banks have got all this scrutiny on us, and we have to produce our metrics, our portfolio report, and we want to share whatever investors want to see without us bombarding them, they can see.
A great number of investors have stayed with us from the very beginning.
CapitalHQ, what sets them apart, the speed at which they work, together with their commercial approach, helps borrowers time and time again to get deals over the line.
You need to know that you've really got a partner who's able to understand what's going on the journey of the project.
I've been investing in the KHK bond now for probably about 4 years, but it pays very good high interest rates to investors.
It was an absolute pleasure to work with KHK, and we're delighted to have been able to launch these 2 bespoke bonds for KHK's investors.
I'm a personal investor in this business as well, and it's my money, my family's money, but we're not trying to shoot the lights out and take over the world and beat the competition. There's a good product. While that good product exists, while those good returns exist, I'll be putting my money in it and taking anyone who wants to come along for the journey.
The largest investor in KHK is still the Kent family's money.
Buy the bond and we pay you 9% interest in return.
I'm Nick Coleman, CEO of Market Space Labs. I'm here to talk about Hero, a new type of peer-to-peer marketplace platform initially for pop culture collectibles that solves some of the biggest problems collectors are facing today. The collectibles market is growing rapidly and is predicted to be worth a staggering $443 billion in 2024. Entertainment and pop culture collectibles represent just over 27% of the total market at $120 billion. If we can secure just 1% of the market, Hero will become a highly successful business. The growth of most pop culture and entertainment collectibles has far outpaced other more traditional collectible markets by more than double over the past 10 years and shows no sign of slowing down. It's mainly fueled by globalization, movies, TV shows, social media, gaming, and a new generation of affluent millennials that have started collecting the things they grew up loving. Former niche collectibles, such as original comic art or music and movie memorabilia, have now become mainstream. This is evidenced by the world record-breaking sale of Freddie Mercury memorabilia and clothing that sold for over $50 million at Sotheby's last year. We have already had $1 million invested in the business from the founding team that has been spent building out the first full version of our product and many of the key features. We have a full suite of native mobile apps and a web app that are all running on the same code base and are available to download today from both the Apple and Android app stores. The new Hero branding will be launched within a few weeks. We currently have over 800 users signed up with accounts, and we have 150 monthly active users. There are over 1,800 collectibles already uploaded, with over 400 being offered for sale. As collectors ourselves, we have identified the key problems that people face when buying, selling and trading collectibles. Auction houses can be trusted, but they take around 35% of the sales value in fees, which collectors pay begrudgingly. Marketplaces such as eBay are too generic and full of fakes. They generally favour the buyer over the seller, which puts off sellers who are the hard to get side of our market. Sellers find it extremely stressful to ship valuable, fragile items such as original comic book art, and there is currently no end-to-end, easy experience to pack, ship, and properly insure most collectibles. Collectors also find it hard to find the things they're looking for and discover new types of collectibles that could appeal to them without them having to spend a lot of time and effort. The solution to this is what we call a market space. It's a low commission, built for purpose marketplace where you can buy and sell peer-to-peer, combined with something we call spaces or galleries, where collectors can upload images or videos of their collectibles and display and curate them for other collectors to see and comment on. This creates engagement and builds engaged communities around each collectible market. Collectors can follow other collectors, comment on their uploads or spaces, and message them to propose deals to buy things that are not initially for sale. Or they can agree trades for things they have or things that they want to have. Trading is simply not possible on a typical marketplace that doesn't have this type of functionality. Additionally, spaces for showing off what you collect enables collectors to discover things that they like that they may never have found otherwise, and this is important. On Hero, sellers can set a listing as an auction, buy it now, or make an offer. They can sell using static images or short form videos of a couple of minutes each. Buyers' payments are held on trust via Stripe until the buyer has received and confirms they are happy with their purchase. In addition to this, sellers are verified through our onboarding process, and buyers can verify themselves and therefore be more attractive to sellers by paying a small monthly subscription. Also, we charge no fees to our sellers, as they're the hard side of the market. So if you list something for sale on Hero, you'll get 100% of the selling price. All fees are paid by the buyer. We offer custom branded packaging to sellers so they can ship valuable items safely and securely without any hassle. The most appropriate and cost-effective courier service is paid for at checkout, which we also offer, and this is trackable through our app. And we also offer a no quibbles insurance policy in real time, which is also paid for by the buyer at checkout. Because we offer an end-to-end packaging, shipping and insurance service, not only can we make a margin on these ancillary services, but most importantly, we offer both buyers and sellers complete peace of mind, and buyers will get the item they ordered or their money back. That's our promise. All of this means that we can offer a much better experience than our competitors for a lower cost. There's no other marketplace we know of that offers this. We operate a hybrid business model, charging 8% commission on each transaction, alongside a margin on all logistics and ancillary services, and a subscription for verifying buyers and other premium features. We also intend to charge users in-app payments for various additional services, such as promoting their sales listings. We believe we can reach £150 million in gross merchandising value and £35 million in gross revenues by 2029. Our projected average transaction value is around £235. We have a highly experienced team of industry professionals and insiders that have first-hand knowledge of how to build and scale a platform such as ours, with the know-how and contacts to get us past the cold start problem. We are currently looking to raise £500,000 to give the business a runway of 12 months to build out and optimise all the features of our product, which we have projected will generate revenues of £250,000 by June next year. Hero is starting in the atomic network of original comic book artwork, which is a market the founders know very well and have a deep network of connections to many of the key players. I myself have been a collector of original comic book art for the past 35 years, so I know this market really well. Getting these collectors on board to buy, sell and display will be key to getting us past the cold start problem and achieving product market fit. Thank you very much for listening. That's Hero.
Hello, my name is Steve Seeley, Chairman and a founding shareholder of Hope Capital Limited, a company set up with my son Jonathan some 13 years ago. I'm here today to tell you a little bit about our company, what we do and how we've grown up over the years, and also explain to you about our current fixed income investment opportunity, which yields 10% per year over a 36-month period. So what do we do here at Hope Capital? Well, we are a specialist provider of non-regulated bridging loans in the UK of up to 18 months, secured by a first charge over a particular residential, commercial or semi-commercial property that we lend on. Bridging finance, as it's known in the UK, is an £8 billion sector and is used by property developers where normal banking arrangements on finance cannot be utilised. Established by our family money in 2011, we quickly grew using our own funds and latterly other high net worth and family office money. In 2018, we brought in our first institutional funder and then last year brought in our second. We are currently talking to 2 others. Since inception, we have lent over 300 million to our borrowers, and our loan book currently stands at £75 million. So why are we different? First and foremost, we have excellent people. Based in the northwest of England, we have an extensive team of 35 consisting of sales, marketing, underwriting, loan management, and together with our own HR and legal departments. Our unique approach to the market makes us one of the leading players in our sector, both in terms of customer satisfaction and award-winning service. Speed and surety of funding is our USP, unique selling proposition. And whether it be for a refurbishment, a capital raise or an auction purchase, we are one of the fastest funders in the market. That said, I always say it's very easy to lend money to people, but the hard part is how do you get it back? Well, at Hope Capital, we have an extensive risk mitigation strategy for all our loans. Each deal is secured against the first legal charge on the property concerned, together with personal guarantees on the borrower and a power of attorney over all their assets should they default. Now, most of our loans are around 12 months and 80% redeem on time. Some borrowers do extend, and this is fine as long as we can agree new terms. But in the very rare cases that a borrower truly defaults, we act very quickly. We appoint a land and property receiver, seize control of the property and assets concerned, and sell them off at the very first available auction. Now, I must stress that these cases are very rare indeed, but we are proud of the fact that in over 13 years of business, we have not lost any capital whatsoever on any deal. A key fact is that we always define the exit strategy on any loan prior to the lend, and we monitor each loan throughout its term, paying monthly visits to the property in question, ensuring that agreed milestones are met by the borrower. We have further security by the fact that our average loan size is relatively small, around £300,000 to £400,000 each, and that we only lend up to 75% of the value of any particular property. We always, therefore, have at least 25% equity headroom in each loan. So how can you be part of our story? Well, Hope Capital is in the next phase of their growth plan, and we want to give you, as an investor, an opportunity to co-invest alongside us in our growth. We wish to grow our loan book to £100 million over the next 18 months, and to do this, we need to raise up to £50 million from high net worth individuals. This will be on a fixed term basis, fully secured until the end of 2026, and we will pay out interest at a rate of 10% per annum each and every quarter. The investment, which will be deployed over our loan book portfolio, will be secured by a set of legal documents, giving a debenture and first ranking over the relevant SPV, together with the comfort of knowing that our money is in each deal, and that in the unlikely event of default, Hope Capital takes first loss. So, in summary, we are going to give you the chance to invest in a strong, well-established company with an excellent track record. We are looking for a minimum ticket of £100,000, and we will pay interest quarterly at a rate of 10% per annum. We have our own money in each deal and offer security by debenture and massive headroom in the loan book. Our current loan book is in great shape, and our pipeline is as big as it's ever been. If you would like to participate in this opportunity or would like further information, please do not hesitate to contact me using the on-screen details. Thank you for listening. I look forward to hearing from you soon.
Hello, I'm Rob Hampson. I'm CFO of Fox Robotics. I'd like to talk to you about Fox Robotics, who have developed the UK's first autonomous outdoor logistics rough terrain robot called Hugo RT. Hugo RT robots are commercially available and currently used by farmers to transport soft fruit and increase picking time by up to 20% by removing the time spent running between picking locations and collection points. Hugo RT is a battery-powered autonomous outdoor logistics robot capable of carrying any load up to 200 kilograms and towing 500 kilograms. Hugo RT is able to capture real-time data, which can be reviewed at any time. The robot has been designed to be used all year round as a multi-use collaborative robot platform that will be able to support agricultural attachments such as weeding, grass cutting, spraying, among others. Return on investment is based on work previously completed with Boxford Farms. We've extensively covered any IP developed as shown on this slide, with a patent application filed and copyright for any software. Due to the size and function of this particular robot model, Hugo is able to navigate easily down the narrow polytunnels seen across the UK and Europe. The markets where this technology can be implemented are limitless. We're working with several soft fruit farms across the UK. Vineyards and multi-crop farmers who grow vegetables, fruit and flowers are also interested. These farmers support our technology and see Hugo being used to automate their needs. Many of the farms in the UK have fields in Europe, allowing us to enter this market a lot quicker. Fox Robotics' UK soft fruits logistics automation opportunity is estimated at 60 to 100 million. This slide shows the functionality compared to our competitor products. Fox Robotics is the only level 4 automation outdoor logistics robot currently on the market. In terms of our financials, we're currently pre-revenue, aiming to sell a small number of units in 2024 and then rapidly scale up both sales and production, which is partly what this funding round is aiming to achieve. We have a revenue stream coming from the sale of the robot, associated hardware such as Ola hubs and RTK transmitters, and recurring revenue from software licenses, cloud services and maintenance. Funds raised will be used to carry the business through the final stage of the commercialization of his product, scale up the opportunity in terms of working capital to build robots for sale, and developing our sales, marketing and manufacturing functions. We have a Innovate UK grant, which covers a lot of our R&D expenditure, but there's still a need to self-fund R&D through the grant period, but also to develop the next versions of the product. In terms of our team, they're highly experienced. Gary Livingstone is a co-founder and our CEO. Dominic Keane is a director and also the founder of BritBox, a leading fund in robotics. Paul Soanes, a serial entrepreneur and founder of Worth Capital. Christian Gorda-Puller, our chairman and an expert in IP. Henry Acevedo, co-founder and our CTO advisor, and myself, Rob Hampson, CFO. In terms of the market opportunity, we spent a lot of time looking at the farms that we could operate on and what market share we think we could obtain. Due to the size of this model, because it can be used on so many tasks, we think there's a wide application across many farms, maybe with the exception of dairy and arable. One of the many challenges across the UK and Europe is finding farm workers to harvest. We're faced with a situation where wages are increasing with a resultant increase in costs. There's an increased focus on sustainability, and there is a decrease in the availability of seasonal labour. You see from the pie chart on the right that transportation of produce takes up to 20% of the time, and this is where the Fox Robotics robot Hugo can help, freeing up that time to help farmers and their workers spend more time on picking, increasing their productivity and reducing their costs. The agricultural sector has exploded with lots of ideas, but there are a limited number of companies who have launched autonomous robots that are focused on outdoor logistics. Our main competitors being Burrow, who are focused solely on vineyards in the US and Australia at present, and Antibot, a British-Chinese company which has created a prototype that focuses mainly on crop surveying and transportation of grapes in vineyards and has a low weight capability. Fox Robotics is leading the way in agricultural logistics. As you can see from this slide, we're the only company to have achieved level 4 automation. Thank you for your time. If you'd like to know more, you can contact us through the contact details below or through the investor portal.
Hello everyone, I'm Dr. Elena Groß, a neuroscientist, PhD in clinical research, and the CEO and founder of Keto Swiss. I'm basically here today to tell you why this is no longer me. These are my attempts to illustrate what it's like to have chronic migraine about a decade ago. What started as a personal story turned into a global mission: fuel brains to reclaim lives. It is our vision to become the world's leading brain health platform, focusing on preventative solutions that improve brain metabolism. The world we live in today puts a constant strain on our brain health. This can manifest in many different ways, many of which we aim to address in the future. One of these ways is migraine. Migraine is the second biggest cause of disability worldwide, according to the WHO, and the first among women under 50. Despite this fact, there are no solutions targeting the root cause of migraine available, only symptomatic painkillers. It is also very expensive for society, and 150 million patients are in pain most of the time, like I was about a decade ago. Also, over 90% of patients are dissatisfied with current treatment options. What if I told you that migraine, or at least a large subgroup of migraine, is in fact as much a metabolic disease as it is a neurological one? And despite food having never been as abundant as it is today, what we eat has changed drastically in the last 10,000 or so years. And very simply put, on these modern Western diets, these energy-hungry migraine brains are actually starving. And it's this energy deficit that could be at the root cause of migraine. Well, why is that good news? Well, we cannot do much about our neurological hardwiring to date, but we can fix metabolism to a large extent. And this is what we aim to do with MigraCat, our dietary migraine management product. The concept behind MigraCat has been awarded several prizes, was recently published in Nature Neurology, and is also patent-backed, with the first of 4 patents having all claims approved already. And it seems efficacious in this newly defined metabolic migraine subgroup. Now, a recent clinical trial on a non-potent first version of the product in 40 patients at the University Hospital in Basel showed a 30% responder rate. In responders, almost 60 days with more migraine reduction over placebo. Treatment response could be predicted with 3 simple biomarkers, and there were no safety concerns compared to placebo. We've just launched in the US this year and in May, and what could be better than first customers telling us about their experience about it?
My name is Pia. I'm here in Switzerland at the CapitalHQ conference. I came in this morning with a horrible migraine headache. Pain scale really close to 10, 9 to 10. It was really bothering me. I couldn't concentrate. I approached Lana because I knew her work was with migraines. So she gave me this product right here. She said, take it, mix it with water and take it. Took it immediately. After about an hour, my pain scale went down from 9 to about 5. But like after 2 hours now, it's actually 0. So I was just so amazed. I've never had a product that could manage my migraine so dramatically immediately. I'm just so mind blown and impressed. Definitely worth trying. Thank you so much.
Due to the safety of our compound, we have a special regulatory situation that allows for a medical food product, which is something in between a supplement and a drug. It's basically the best of both worlds. Faster go to market over a drug, no side effects, no major side effects, and it allows for disease claims, which supplements are not allowed to do. Due to the lack of solution and the huge number of patients, the migraine market represents a massive opportunity. If we were to reach only 5% of high frequency and 1.25% of medium frequency metabolic migraineurs in Western Europe and US alone, and not do any line extension at all, even though this is planned, this would already lead to a total predicted revenue of up to $2 billion at peak market penetration. So there's certainly unicorn potential here. Apart from making the world a better place, as you've just seen with Pia, MigraCat offers a huge market opportunity. Comes at $98 a box, including 30 sachets, 73% gross margin, a customer acquisition cost current average of around $100, and the retention rate right now is already over 10%. Since patients have to take it on average 2 times a day for years to effectively manage their migraine, this also leads to a high customer lifetime value, subscription model based on D2C channel at first, an omni-channel approach, as well as an easily scalable approach with low additional overhead. MigraCat has just launched in the US a month ago, but we're not stopping at migraine. A depression trial is fully funded and has already started. The ultimate goal is to become the world's leading brain health platform, focusing on preventative solutions that improve brain metabolism, including aging or longevity, as well as novel ketogenic compounds with substance of matter protection. In the last couple of years, we've raised roughly $6 million in grant money, a seed round, convertible loans, and a pre-Series A round. We're currently starting a Series A round of around $5.9. Our diverse management team has over 100 years of work experience in this space, great education. Our marketing team continues to grow in the upcoming launch. And thanks to MigraCat, this is how I feel today. So if you would like to help us fuel more brains, please fuel Keto Swiss. Thank you so much for your attention.
Hello, my name is Paul Sampson, and I am the founder and CEO of Licht. And today I want to talk you through our investment offering. So what is Licht? Well, we are the first and only provider of the world's best mainstream music for social content creators. We are a platform that licenses the biggest music in the world to YouTubers and other digital content creators. We provide the largest ever catalogue ever assembled of over 1.4 million mainstream music tracks and 140,000 stock music tracks that content creators can legally use without fear of copyright infringement for the first time. From top chart hits to hidden gems, we have music from over 10,000 of the world's largest labels and publishers, including, as you'll see at the bottom of my screen, Universal Music, the #1 label group in the world, Warner Music, the #3 music group in the world, Empire Records, BMG, and like I say, over 10,000 other labels and publishers that have already signed up to Licked. Now, prior to Licked, there was a problem using copyrighted music on YouTube and other social media platforms. That problem revolved around a piece of software that YouTube owns called Content ID. And Content ID presumed that all major or famous or mainstream music used on its platform was a copyright infringement because there was nowhere in the world to get the rights to use the music. And the unintended consequence of Content ID is that creators that monetize on YouTube, i.e. those that earn any money at all from their YouTube videos, and by the way, that sector commands more than 90% of all the views on YouTube, actively avoided ever using mainstream music in their content, despite having the will and budget to do so. Until Licked, there was nowhere to attain the rights and the licenses from the multiple rights holders involved in each and every song. And so we built Vouch software. It's proprietary software that we call Vouch that prevents the automation of copyright claims by Content ID if the song has been legally licensed through the Licked platform. Vouch, as I said, is proprietary. It's integrated into the YouTube CMS of every label that signs with us. And actually, it's so good that Epic Games, the creators of Fortnite, licensed just the software from us on a yearly basis for over 7 figures a year. How does Licked work? Well, you sign up, you find your track, you search and audition all the music that we have, and you find the track that's right for your video, and then you purchase and check out as you would on any other e-commerce store. You have to attribute which song you use in the description of your video. But when you upload the video to YouTube, our Vouch software protects you from any automated copyright claims that would otherwise appropriate your income. And as soon as that process has been cleared, which happens in seconds, you are free of copyright claims as a creator, able to keep and earn the money due to you from your video, and Licked pays the music industry out of the license fee that you paid us. Today, some of the world's biggest creators, including here, as you can see, Mr. Beast, Logan Paul, Sidemen, Airrack, Chris MD, and thousands more, are able to use and are using the world's biggest artists. Coldplay, Dua Lipa, Justin Bieber, Bruno Mars, Drake, Sia, Megan Thee Stallion, Sam Smith, and many, many more are all available to these creators and being licensed on a regular basis. On to pricing. To pay for Licked, you have 2 avenues. One, you have a subscription fee of $15 or £10 a month, and that gives you unlimited access to the 140,000 stock music tracks that we provide. On top of that, starting at $8 a song, you can license a la carte any of the 1.5 million mainstream songs that we provide. The bigger the creator and the larger their audience, the greater the fee they pay to license the music. So an entry-level creator might license a Coldplay song for $8 on day one, and on that same day, a larger creator might pay $330 for the very same song. And the prices are built out at an estimate of approximately 10% of expected earnings from the creator's video. How is Licked performing? 24 months ago, Licked was pre-revenue. We have shown a very steep upward trajectory since then. In Q1 2024, Licked generated £890,000 in gross revenue. In that 24 months, our MOR has increased over 10x, and Licked is at a revenue inflection point. And we have now passed £2 million ARR run rate and are still growing, with an expected gross revenue in 2024 of £4 million. Recently, Licht signed blanket publishing agreements with Warner Chappell Music Publishing, Universal Music Publishing, BMG Publishing, and Cobalt Publishing, 4 of the 5 largest publishers in the world, to mirror the label deals we had with their counterparts. And that has meant that our catalogue of music has grown significantly in size and in quality. You'll see the artists that I've mentioned thus far have all been enabled and gone live on Licht as a result of those recent deals being signed. There are 1.5 million tracks live on Licht, but there are 10 million songs already delivered to us, waiting to go live next. And as a result, we've been able to attract, convert, and retain the biggest YouTube channels in the world as returning customers. You can see here our revenue journey since being pre-revenue in 2021. The 2021 figure of 262,000 was all partner revenue. It wasn't core business or e-commerce as planned. But in 2022, we commercialized the business, delivered £855,000 in revenue, 1.3 million in 2023, and are on course for over 4 million in 2024. So you can see the progress we've made in the last 24 months, and we're projecting 300% year-on-year growth and are very confident of achieving it. Similarly, the optimizations and return on investment we're getting from marketing are paying off dividends. You can see that today we get a 4.7 to 1 return on every pound spent in marketing. So our LTV to CAC ratio is 4.7 to 1. And we're constantly iterating and optimizing our outbound activity while also making the changes and optimizations needed on platform to increase conversion and retention. We are now light years ahead of the incumbents and the competition. I mentioned that prior to Licht, there was nowhere to get mainstream music. This meant that content creators were limited to stock music companies. On the right, you will see MusicBed, Epidemic Sound, Soundstripe, and Artlist. These are the incumbents, and they only offer stock music, not a single famous song between them. Their catalogue range in size from 30,000 to 65,000 tracks. Licht offers 140,000 stock music tracks, and as I mentioned, over 1.5 million mainstream songs and growing. But these companies, with their limited offerings, have already achieved 9-figure valuations. In fact, in the case of Epidemic Sound, they raised $450 million in 2021 at a $1.4 billion valuation. We are the only people offering stock music and millions of mainstream songs, and our ceiling is very, very high as a result. We are 35 times larger than the leader in the space in Epidemic Sound in terms of catalogue size. And recently we've discovered there's even a business case for creators to use Licht or famous music, in that using famous music results in a 22% higher engagement rate in key metrics like comments, views, likes, and watch time. And 22% uplift in engagement means roughly 22% uplift in revenue. So using famous music will actually earn you more money. The funding round. What are we asking for? To date, we've raised £16 million, and that's come from an investor base that includes Warner Music Group, Epic Games, the creators of Fortnite, and the Nick Mason Group. Nick is the drummer from Pink Floyd, and he heads up a consortium of high net worth music and media luminaries, as well as Universal Music Group, who are also on the cap table. In this round, we will raise £2 million, and the reason for the funding is to get us to break even. Licht will break even in Q2 2025. We'll also use the money to scale our talent and operations, our technology team, and our marketing efforts. That's it for now. Thanks for listening, and I look forward to answering any of your questions.
Welcome back, everyone, to CapitalHQ, where for this session, we're going to be diving into the heart of tech due diligence. Joining us is Chris Phillips, founder and managing partner at Phillips & Byrne, named synonymous with excellence in the tech due diligence industry. Since 2019, Chris has been at the forefront of guiding funding and strategic technology assessments, helping startups and investors alike navigate the complexities of the tech landscape. He has been an interim CTO for a long time in various different organizations, so has a lot of experience there. With a career spanning over 2 decades, including roles as an engineer, CTO, and now as a leading advisor, Chris brings a wealth of knowledge and insights. Today, he will share his expertise on what makes tech startups succeed, the nuances of tech due diligence, and the future trends in technology investments. Get ready for an enlightening conversation full of actionable insights. Welcome, Chris.
Happy to be here. Thanks, Google.
Great. Look, let's get stuck in. And before we dive into the depths of tech due diligence, could you share a bit about the ethos and mission that drives Phillips and Byrne in the tech advisory landscape?
Yeah, absolutely. So we always say we help founders and investors build the world of tomorrow. And that probably sounds like a huge ambition, but in the essence, that's exactly what we do. Yeah, I mean, the way I see the startup scene is that we really use the opportunity to build another world, to build another future, hopefully a better future. And having been already part of the startup industry for more than 20 years, that's always my ambition. And by advising investors on one hand, but also advising founders, entrepreneurs on the other hand, that is definitely our mission, that we want to help build that future. Apart from that, I mean, we have this mission in place, but also we have a kind of prime directive, principle number 1 in our company, and that is zero bullshit. You also find that present on our website. And we not only write it, but we actually mean it. It's our moral compass for our work, but also for our own company.
Okay. And where did this zero bullshit philosophy come about?
Yeah, that comes from my history as an interim CTO. I once had a colleague from the US who had worked with me for a couple of years, talking to me over a beer, and he gave me that feedback. He said, like, you know what I value most about you is like you're absolutely zero bullshit. I always know where I stand. I always know this is the truth. Yeah, and then we can operate based on that. And I like that feedback a lot. And I think I made it to my own personal first principle, and then I introduced it also to the company later on.
Yeah, and it's one of the things I've taken on when I started working, because I work with a lot of founders. I help them with their due diligence materials, not to the same extent as you do, but I do that as part of my everyday day-to-day role. And after 5, 6, 7 clients, I was like, look, I'm gonna be very brutal with you because it's better it comes from me than it comes from a potential investor. And at the start, I was a bit wary of saying that because it kicks off the relationship between a business and a client a bit off. But today I use that every time I get on a call, and they seem to enjoy it. So I relate to your zero bullshit. Well, look, with over 2 decades in the tech and startup ecosystem and now leading Phillips and Byrne, can you share how your journey has shaped your perspective on tech due diligence?
Yeah, I started as a typical techie, I would say. So I used to work as a software engineer for quite a while and had various other roles in engineering before I eventually became a CTO and then an interim CTO of more than 10 years. But still, I had this typical tech perspective. And then when I had my first due diligence, not as an auditor, but being on the other side of the table, that was really an epiphany for me. Because suddenly I got confronted with what the outside world would consider as standards. And I think that was a very valuable lesson for me. Fortunately, we got the funding. Fortunately, the startup grew. Nevertheless, it made me think a lot about, like, from a higher perspective on what actually a good technology organization needs to bring to the table. That was one aspect, but the other one, and that is probably even the strongest driver, I had to endure throughout my career a couple of, let's say, bad tech DDs. In that sense that for me as a CTO, it was an absolute waste of time. And the insights were very, very limited. And there was almost no feedback whatsoever for me and my team. And I found that a pity because we invested a hell of a lot of time into preparation for that tech DD. And in the end, we left with nothing. So I swore to myself that if I ever would perform a tech DD, I would try to turn it around and set it up in a way that it's highly valuable, not only for the investors, but also for the startups, for the teams being involved. I always say it's the most thorough and most honest feedback that you can get as a founder and as a CTO. And we try to stay true to that principle.
Yeah, and I mean, it's interesting having sat on both sides of the table. And I think next question is, how do you believe the diversity of thought, right? Because I'm guessing when you sit on either side of the table, the way you approach something is completely different, right? But the end goal for both sides is to build something and move together. But how do you believe, having done both things, how do you believe that diversity of thought and experiences enriches your tech due diligence processes and perhaps Phillips and Burns?
What I always feel is that we have a different perspective from many, many other consultancies performing DD, especially like the bigger ones, because our team has a different DNA. We all come from the startup scene. We have all worked in startups and scale-ups. And that's a huge difference because we have felt the pain ourselves. And we usually are not business analysts performing a tech DD. We are techies. Yeah? We are engineers. We are architects. We are former CTOs or directors, VPs. And that is definitely something that influences massively our view. But there's also a second perspective that I gained when I became a founder myself. When I was an advisor, I was always like advising CEOs how to build and lead their company. And one day I looked into the mirror and said, like, who am I to advise someone if I haven't built my own organization and my own company? And this was actually the primary motivation for me to build Phillips and Burn. And that changed my perspective entirely because I suddenly found myself in the exactly same situation, and I did the same things or the same mistakes the other founders did, and what I could watch over the years. And although I knew I couldn't help myself, but making the same mistakes sometimes, and I understood this the thinking better, why founders tick the way they tick. So that was really an eye opener for me, and I think that has also massively influenced our perspective with that regard that. We understand the pain, also the founder's pain, and we can sometimes translate it to investors, but we very often also know what to do in order to mitigate the risks going along with that.
Fantastic. Yeah, being put in the driver's seat, I think can do that. I haven't been there myself, so sometimes I speak to founders and I find myself in this situation where I'm telling them like I've worked with hundreds of companies. And then they're like, yeah, but you've never run one. You know, I have people I have to feed. You don't have people you have to feed. I was like, yeah, fair enough. But look, for the purpose of this conversation, I think, you know, and this concept has quite a few definitions, but I'd love for you to explain what tech due diligence is and its critical importance in the investment decision-making process.
Yeah, I always like to boil it down to one simple question. Like for me, tech DD is the answer on the question, does tech and product have everything with regards to people, process, and technology that it needs to achieve the business goals? That is what you need to figure out in the tech DD. And if not, what needs to be done in order to get there?
And given your vast experience, how has the approach to tech due diligence evolved over the years, perhaps from a founder and an investor's perspective? And That's first part. So maybe we can talk about the last 10, 15 years, your experience, and perhaps we can touch on the rapid technological advancements happening within the last year and a half.
Yeah, absolutely. So I started with like my background and my thinking as a technologist and as a one-person show. And I think that has influenced the first couple of years, especially first 5 to 10, I would say. And this is what I see nowadays a lot. I see many brilliant technologists conducting DDs as a kind of single person show. And nothing against that. It can be exactly the right context for, or the right thing for some context. However, I realized that the more DDs that I performed and later on we performed, and we have performed around like 700 DDs by now. So you could see that the most important thing is having a framework, having a framework of conducting DDs, but also a framework of standards and best practices you apply and you benchmark companies against, considering certain contexts, certain stages, certain industries, etc., and also having the data to benchmark the companies against similar companies of that stage, that industry, etc. So that is definitely something that has evolved, I would say, throughout the last 5 or 6 years, and has become a focus in our work. I mean, the last 1.5 years, probably you refer to the big paradigm change through AI. Of course, that has been super exciting also for us. I still remember when the first release of ChatGPT came out. I spent probably personally half a day on just like bombing it with anonymized data, seeing what I would get back as a result. And that is definitely, of course, in part of everyone's discussion right now, also strategic discussion, like will consulting survive? Will assessments survive? How well will they look like 5 years from now? Yeah. So, and I don't think that there's a way around AI, or ignoring it would be a smart idea. However, I think there's, at least for a couple of years, there will be a hybrid approach. And I believe in that hybrid approach. I mean, nobody knows how it will exactly be with GPT-5 or even 6 down the road. But nevertheless, I think there will be still space for heavily tech-supported analysis and consulting driven by people, or at least aspects of people, such as empathy, expertise, and experience, in order to get the nuances right. And as long as people are involved into businesses, people are the main thing to consider. I mean, I always say, like, it's when I started, I thought it's 90% people and 10% tech. Nowadays, I'm tempted to say the problems are related of 99% to people and 1% to tech, right? So, and as long as there are people, it's good to have also people on the other side of the table. But what needs to be clear, the times for expensive, so stupid consulting, these are over, and that's, in my eyes, a good thing.
Yeah, and look, talking about this from maybe a different angle, technological advancements, has that made your job harder? Because maybe the concepts are more data hungry, they're maybe a bit more complex. Has that made your job harder in general?
I would say that has made our job even more interesting. I mean, we were in the lucky position that we, I don't have the numbers for 23, but for example, in 22, 30% of our DDs were AI related or deep tech related. So, and to be honest, although of course the other DDs are also interesting, but these ones were thrilling, especially like looking into looking into companies who are OpenAI competitors and develop their own large language models. I mean, that's super exciting for technology teams, right? So we have built up a certain expertise in the field of AI and are capable of going down very, very deep the rabbit hole. And so with that regard, it has also kind of shaped our understanding of the landscape and has excited us so much that some of my colleagues really, really went into it and built up a really good expertise in it. So we are not afraid of assessing complex technology companies. Sometimes we even go, I lively remember a company in the quantum computing context that was totally innovative back then. And that gave us a pretty hard time from a TechDD perspective because no framework worked. Yeah? So, but nevertheless, these are also highlights in the history of each and every assessment company or consulting company. So we love it.
Absolutely. Sounds like it. What are some common misconceptions about tech due diligence that you've encountered, and how do you address them? Maybe we can do this from answer this in two parts. The first one can be an investor part, and the second one can be a founder's misconception.
Nice one. Let's start with the founders. So we see two main misconceptions here. One is some founders understand the DD as kind of a hide and seek competition. Yeah? And I understand that in an M&A context, but let's say I understand that in a highly political M&A context. I don't understand it in a VC investment context or in a very friendly M&A context, because I think it's a wasted opportunity of getting feedback, also on putting the real problems on the table and see how you get along with your future shareholders or even like partners. And so that is something where I highly encourage founders not to play too much of hide and seek and be open and be upfront with whatever challenges are existing. Also, it goes hand in hand with that a DD may be a waste of time, but that is also because not every DD is a win for the team, and not every DD is valuable. So that's more like on the consulting side to change that. On the investor side, my favorite misjudgment is this is the commodity. This is commodity. We don't need a tech DD here. I don't know how many times I heard that sentence, and I think it's wrong. It's in 90% of the cases it is wrong, because I mean, let's take a simple e-commerce or SaaS or marketplace model. Yeah, people are always like, that's commodity nowadays. Yeah, that might be true, but there is no like plug and play tech framework or tech solution for that you install within a day, maybe apart from Shopify for e-commerce, but even that takes sometimes and needs some tweaks. But especially like, let's say in a SaaS environment, there's still a lot of tech under the hood, and if you have a business model in a highly competitive situation or landscape, then it's crucial that your product engineering delivers at very like fast iterations and a lot of value. And if that is not the case, you just might lose the race, and then you might have the most sophisticated business model or the best whatever. You will not win the race about market share. And this is why I always try to encourage investors, even if it's commodity, to look closer at it, so that we can give some recommendations how to make it more effective or more efficient, or whatever it is that you need to do in order to loosen the brake.
Yeah, yeah, those are two very good insights. Definitely, definitely. Could you maybe walk us through the key components of a comprehensive tech due diligence process, and maybe part of the framework? I don't want you to reveal your secret identity at Phillips and Byrne, but if you can reveal some of part of it.
Yeah, of course. I mean, of course, you start with the investors. You really want to understand their motivation, why they're investing into something. Then, on the other hand, on the founder side, it's important to create transparency very early on. They need to know, and they have a right to know what is expecting them, and also to build that relationship, right? And then, of course, you have a lot of data ingestion and processing, like automatically or manually, like through the data room or similar sources. And then, I mean, I know that this part is handled very differently across the industry. Like, we still heavily rely on interviews because, as I said, I believe in people interaction combined with data. So that's the interview phase. And then last but not least, there's of course the aggregation phase with a report as a deliverable. And we are always big fans of discussing the report, not only with the investor side, but also later on with the founder's side, so that they get the most of it, the most out of it.
Yeah, and in this process, how do you assess the scalability and future readiness of a startup's technology platform in general?
Yes, from a technological point of view, or let me start differently. First of it all, we want to understand the business, not challenge it, but really understand it, because I'm a believer in context, and the business case and the growth strategy are the context for tech. And after we have understood that, when we look at technology, we look at the architecture, because the architecture in the end is the reflection of the business that you build, translated into technology, plus like organizational setup being reflected in technology, information flow, so to say. So we look in detail into that, and also like into infrastructure. We very often have conversations about it, like kind of in-depth architecture workshops on a whiteboard, making it as visual as possible, because I mean, I also learned very early on that people speak very different languages, assuming they mean the same, but they don't. So visualization always helps. Like, in addition to that, we also do detailed analysis of data, of course, but we also do live reviews, for example, of monitoring dashboards or similar things, because that is always fun, and also speaks, let's say, speaks also another truth than just looking at architecture.
And if we move on to kind of discussing risks, what red flags do you commonly encounter in this process, and how should companies address these prior to even going into a due diligence process?
Yeah, I would say there are a couple of things, and again, it always depends on the context.
Yeah, of course.
If you talk to a VC about a Series A funding, it might be an entirely different context, rather than wanting to sell your healthcare company to a big corporate, right? I mean, what might be considered a red flag in the letter will maybe not make a VC raise an eyebrow. I think that's the reality. But let's stick somewhere in the middle. I mean, one thing, especially like when you're about to really scale, you should make sure that you don't have any hygienic issues that just inhibit your growth here, such as some legal stuff. Yeah, that, for example, you had these 10 freelancers in the first 2 or 3 years building your software, but you never made any contracts with them. So the IP question is unclear. That would be, for example, a very unfortunate situation. Then that doesn't say anything about the quality of your tech or the quality of your business, but it will give you a headache. So, and there are a couple of such topics, such as like GDPR or like open source software licenses, at least very strict ones. So, this is something that needs to be made sure that everything is in place here. And the other thing is the view on the organization. Do we have the right people and roles in place? And I mean, nobody is perfect. We know that. We come from the startup scene. It's always work in progress. However, at least if I'm a founder and I know, okay, 9 months from now, we want to raise a Series B, then I should make sure that I have the key people on board, or at least most of the key people, and the other ones I should be at least looking for. So that one can see it's work in progress. Another thing is technology. When we look at technology, it should be always the balance. There's always this kind of fight, this power struggle between building it super lean and sometimes even quick and dirty, and shipping and speed is everything. And on the other hand, there's also this ambition to build toward the vision and to build it rock solid. And I think a good CTO always finds that counterbalance and manages to figure out how to build in fast iterations and in a lean way towards that vision. Does that answer your question, or?
Very much so.
Okay.
No, that's great. I think those highlighted some good red flags in that scenario, and I think the way you approached it is different angles, so it gives not just one answer but four, which is good. Could you maybe share an example where tech due diligence significantly impacted the outcome of an investment or acquisition decision? I understand that you might not be at liberty to disclose who and what, so if you want to keep it anonymous, no problem.
Yes. So I mentioned before already the highly competitive situations, and that is, for example, something in a DD. It's rarely just the one thing that is a big fat red flag, and then the investor backs off. Most of the time, it's either if there are question marks on the business model or on some other DD streams, and then tech comes on top, or it is a combination of various tech issues plus maybe a challenge in business. For example, highly competitive landscape, and we go in, do the tech DD, and come back and say like, whoa, tech has so much technical debt, so many things that need to be reworked in order to still have a good velocity in feature development, that they might be busy for the next 2 years just kind of cleaning up. They will have very, very slow output until they have cleaned up everything. So if that is the case, and we say there is barely any way around because they have already produced so much mess, that would be probably a deal breaker. If it's in a highly competitive environment and everybody knows, okay, there are 10 competitors outside there, they will basically overturn them. They don't have a chance. The other way around, if for example, a company does something highly innovative and it's a big bet anyways, and they have the time because there's no competitor on the market anyways, the same issues we find might be more tolerable, and so it could be totally okay.
Right.
Yeah.
So it depends. Yeah. So again, it depends on the context, but there's just that's some general frameworks there.
Yeah. Or another good example is if a technology is absolutely not suitable for a certain problem or for a certain context, or you already know, okay, the founder built it itself with Visual Basic or some like Code Fusion Pro. I think 3 years back, I even saw something built in Code Fusion. I was like, wow, I thought that died 20 years ago or something. But I think that was a case where someone still knew it and thought it was okay and just built it. And as a prototype, it's maybe fine. But if it's already a production system, it will be pretty hard to maintain that over time, and also to find a team for that, right?
Interesting. And I think I have like spoken to someone recently about no code, low code software builders.
Mm-hmm.
Their take on it was that for a prototype, until an MVP, it's okay, but they would rarely see it in terms of a tech business that following a certain stage, they should really think about building that in-house, right? From your perspective, what's your opinion on that?
I totally agree on the prototypical phase or MVP phase. I think have as little effort as possible, and even if it doesn't totally fit, doesn't matter. It's always a trade-off. I'm a big fan of buy overbuild. So also for later stages, if you have the possibility and something is not your absolute core, please, if there's any decent solution out there, buy the component, build a component that is like highly component based, like the components talking to each other via APIs, so a loosely coupled system, so that if you decide to kind of pivot your business or like over time things become outdated, you can relatively easily unplug one component and plug in a new stuff instead of having to rebuild everything. So, and that is the case if you have a lot of third-party components and kind of by decision in there. In terms of low code, no code, it's sometimes it works, but sometimes it's unfortunately an illusion. And the adaptation or the customization rate is so high, and you didn't anticipate that in the beginning, and the complexity is higher than you initially thought, and then you might abandon that path and then eventually build something yourself. That's true.
Right. Okay. Very good food for thought there. And look, we talked about AI a bit already, right? But I want to explore a bit more about the integration of AI within the tech due diligence process. So in that context of AI and ML into technical due diligence, there's a spectrum of opinions on their reliability and depth of analysis compared to traditional methods. From your perspective, how can firms, and maybe how does Phillips and Byrne balance the efficiency gains from automation with the need for a nuanced expert evaluation, especially when assessing complex or novel tech environments?
Yeah, absolutely. So, I mean, that is something where I think the entire industry is still in a mode where we are experimenting and we are making assumptions and we are building first products that support our work. But we all know that might be wiped off the table with the next release of like, for example, GPT-5, or some other technology that kind of is another paradigm change. However, so I think it forces all of us to be even more data focused and data driven, which is a great thing. As I said, we ran experiments on anonymized DD data, and what we saw here, even with GPT 3.5 and 4, for simple context, the results are already pretty surprising. Reality is rarely simple. When we fed it with more complex, multidimensional context, then the limits were reached pretty quickly, and the analysis became quite shallow. But I mean, that is changing on almost daily basis, I have to say. Like 3 months ago, our like experiments on architecture diagram analysis was devastating. Last week's analysis was quite promising. So I think it's important that you place your bets, or you exactly deeply think about how and where to place your bets here. That you increase your AI literacy in general as a consulting company. And apart from that, as I said before, like on the human side, like expertise, experience, and empathy, the 3 E's, will be still important for quite a while. Expertise, probably not that much anymore, because a lot of expertise will be substituted by machine. Maybe at some point also experience. The empathy part will remain for a bit longer, but I think especially you mentioned the nuances, especially in the nuances, humans will have a few more years of leeway, I would speculate today.
Yeah, and I think it's more than a few years, in my opinion. I've spoken with a lot of investors, not about tech due diligence, because I don't know much about it, but I know a lot about, well, know a lot. I know due diligence more, regular due diligence more.
Mm-hmm.
And they say, especially in early stage, right? I'm not talking Series B plus, I'm talking seed, pre-seed, maybe a bit of Series A. The team at the end of the day is the most important thing. And I don't know if the AI will be able to discern Jack from James in terms of who can lead this team better, right? I understand maybe from a tech due diligence, when you look at the data, that can maybe be analyzed quite shortly. It does it in a way that's maybe not great today, but you can see how it gets there. But analyzing Jack from James, from Emma, from Marie, I think that will stay difficult. But what are your thoughts on that?
That's interesting, because that was, I think, my biggest USP when I started doing DD. Investors recommended me to each other, because I was known as that person who also brought gut feeling into the discussion. And it was, I had a pretty good quote, or how to say that, target hit rate, so to say, when it came to talking to founders and feeling whether something was off between them, whether there was an elephant in the room, whether there was a hidden conflict, or like how they interact with each other, what kind of standing the CTO has on among their C-level peers, stuff like that. And that is, even today, that's still, I mean, that's still a topic that is still, as you said, team is focus point number one, and that is something investors want to know. They want to know who to deal with. Yeah, absolutely. And that's still a human domain.
Absolutely. And look, for founders and investors listening, how does engaging with a firm like Phillips & Byrne early in the investment process help them?
It helps in the DD context, or in the DD phase, after the term sheet was signed, by like the hygienic stuff like mitigating risks, identifying risks, etc. But on the other hand, I think the most important, or the most valuable stuff is probably like, okay, can we invest into that? And we answer that question very clearly. Internally, we always ask ourselves the question, if you had 50K as your own money, would you invest into that company? And that question helps a lot in order to make that recommendation. And we also get clear recommendations what to do after the investment. And that is a crucial point that I learned in my time as interim CTO and CTO, when I sat in board meetings, and I had the feeling, sometimes that's not the right discussion here. Yeah, because they didn't consider what was going on in product and tech, and made plans without, for example, being aware of some things not being possible because of some limitations, some technical debt to deal with, or some other potential that was being left aside that could have been utilized, stuff like that. So, but especially in the negative topics, I like to address them within the DD, and I see ourselves and our work as a conversation starter between founders and investors to really address the difficult topics and turn them into a constructive dialogue. And I personally think that is the biggest value that we give, but probably the investors see the biggest value in giving clear recommendations to both the investors, but also to the founders, and of course, including CTO and CPO, what to do next and how to accelerate growth and accelerate progress, etc.
Yeah, because I'm looking, at some of your clients, and it's pretty remarkable on the investor side. Notion, Lakestar, Axel, HV, Early Bird. It's really remarkable. On the company front, it's also very, very impressive. So, I think you mentioned earlier some things that sets you apart in this space, including bringing that dialogue and having that in-person interview, that face-to-face thing. But what other things would you say sets you apart in the market?
I mean, we spoke already about the zero bullshit rule, and as I said, that's my prime directive. So when we don't sugarcoat things. I mean, sometimes we kind of, as you said, sometimes it stirs things up if you don't sugarcoat and are not super diplomatic. But I think it's super important for an honest conversation and also for a tough conversation that is sometimes necessary. And that is definitely something both sides get from us. Another thing is that we have this startup and tech DNA, and sometimes even to a certain extent, the mini investors or wannabe investors perspective, because some of us have also several angel investments, so at least we got a glimpse of that perspective. And last but not least, we are techies. We understand tech. What I see often in tech DDs is that it's a business DD with very superficial findings. And what we do is we start with the business model and this tech strategy, and then we go down the rabbit hole down to the very code level. We look at code, we look at data, we look at algorithms, we look at models, and not many teams do that in that depth without forgetting about the broader context and the business perspective.
From what I've seen also, you do this quite quickly, right?
Yeah, that's true. But I think that's the nature of the business. If you work with VCs and founders, everything needs to happen yesterday. And I personally enjoy it, even if it's stressful. But that's exactly that speed and that this what's the name, like frequency or rhythm that shapes or like kind of characterizes the industry. So I love it. Usually it's 2 weeks or something. We have time, including prep and report and everything. Sometimes it's 4 days. Then it's a bit stressful. So I don't want to burn my team and do that every week. But I like the speed of our industry.
That sounds great. And looking beyond conventional markets that you might be used to, maybe European, and I don't know if you guys deal with American markets, but by the looks of it, you do. How do you assess the potential of tech startups in emerging economies? Is it very much a similar framework, or do you look at it from a different angle?
No, it's basically the same framework, but you need to be aware which market you look at or which country. I mean, we have worked in, I think, 25-ish countries. Most of them being in Europe, but also in North America, for example, or in Southeast Asia. So we know the markets very well. And for example, to pick an example from Southeast Asia, if you look at Singapore and Malaysia, very, very close by, but totally different markets. Because the salaries in Singapore are so much higher than in Malaysia for tech people, for engineers. So everyone who is more or less independent goes to Singapore. That leaves Malaysia with quite a talent drain in the engineering space. So if you want to build a startup in Malaysia, you need to work very, very hard to recruit great tech talent there. And you also need to pay above average salaries. So that is one understanding that you need to have if you assess certain local markets. Another one is that, and that surprises me quite often, that despite all the globalization and globalized tech community, there are always still, let's say, technology hubs in different areas or countries. For example, Eastern Europe. In Eastern Europe is C# and .NET are much stronger than in Western Europe. So that is something that keeps surprising me. I think generally you can say that the US still has a big advantage in terms of best practices and tech talent, density and spirit and attitude. I still find that when I work with US companies, it's not like in 2010 or so when I had the feeling Europe is 25 years behind. Now I would say it's maybe 5, but still you can feel there's in most of the cases still a difference. But I think the European scene has caught up a lot, and also like the scene in non-American or non-North American and non-European countries has really caught up a lot. Of course, also because the differences due to remote work and a more globalized community have been also equalized. So, and that's a huge chance for emerging markets, especially also in the times of AI, where at least that's currently the assumption that organizations will become much leaner, and the capital that you need to build a company will also be much lower. So I'm very much forward looking to the next years what will be emerging in terms of startup scenes.
Yeah, definitely. And I think, I'm conscious of time. We have a couple more minutes, but with regards to remote work that you mentioned there, is that something that comes into the framework when you're doing tech due diligence, or not really?
What do you mean exactly? Can you elaborate?
Like, for example, the development team, the product team, the tech team, whether they're remote workers or not, does that affect the due diligence at all?
Yeah, I mean, of course, we look at it, and the fact that there are more and more remote teams has also massively influenced our work, because pre-corona, in 95% of the transactions, we were on site assessing the team that was also on site. Then Corona came, we all had to work from home. But post-Corona, the majority of the teams we need are working either partially or entirely remotely. So there's no need, or also it doesn't make any sense for us to be on site because the developers aren't. And we want to meet them in their natural habitat. So we switch to remote in these cases because we want to see how they work on a day-to-day basis. So yes, we always look at it. What is the case here? We look whether it suits the company DNA and how the rest of the company works, and whether they have the right tooling in place, the right processes in place, and whether the alignment is still there. Because still achieving great alignment in a remote setup is still a struggle for many companies and many leaders, particularly.
Yeah. And 3 more questions. 2 are quite rapid fire. For the investors in the audience, could you share one piece of advice on how to best prepare for a tech due diligence? Just one piece of advice.
Yeah, investors should exactly know what they want, why they want to invest, and what the expectation is for now, what they expect us to find, and what their expectation is for the next year or two. That helps the company to negotiate expectations and see whether they can meet them or not. And also it helps us, of course, in our work to make a realistic assessment. Is that what you mean, or do you mean something else in terms of expectations or advice?
No, that's what I mean. And now turning it on its head for the founders in the audience, let's assume maybe that they're about to open a round. What was one piece of advice on how to best prepare for a tech due diligence for them?
On the founder side, I like to say that always lead your department in a way that you always could have a tech DD coming within the next 3 months. So have your stuff in shape, but because in the end, I mean, apart from a few bureaucratic requirements, 80%, maybe even more, of the information that are being requested and also assessed in a DD should be there already and should be kind of working artifacts that you use in your day-to-day life. For example, architecture diagram, that should be a living document that your teams use in order to make sure they speak the same language. So it shouldn't be prepared for the DD, it should be there. Same with a lot of knowledge. That advice I can tell to founders and particularly CTOs. I learned that tribal knowledge is something that will cost you a lot of energy and a lot of confusion, or it costs you a lot of clarity as your company grows. So write things down. It might be annoying, but it will save your life.
Great. And finally, how can interested parties get started with you guys from their tech due diligence needs?
Yeah, just ping us. I mean, we are there on all channels, LinkedIn, email, or phone, or whatever. So reach out. You can reach out for regular investment DDs, but also M&A on the buyer side, and also founders who want to sell their company in a few months and they want to have this health check beforehand in order to avoid risk in the DD process. And also if you just want to have an internal feedback and health check, we are there for you.
Fantastic. And first of all, thank you very much for joining today, Chris. It's been an absolute pleasure. And for everyone joining us, thank you very much. We'll have a couple of links in the description with their website, with Chris's profile on LinkedIn. Thank you very much for joining us today, Chris.
Yeah, it was a pleasure for me too. It was really fun. Thanks.
I'm Mike Pettit, CEO of V-Glass. We've developed 100% recyclable, next-generation vacuum-insulated glass technology for affordable, ultra-high efficiency windows. We've raised $6 million to date, $4 million in non-dilutive grants from the U.S. Department of Energy, National Science Foundation, and State of Wisconsin, with more in the pipeline. With that funding, we've developed technology that's drawn strong industry interest. We've already been approached about selling V-Glass, which essentially eliminates the zero return possibility common for early stage investments. So what is vacuum insulated glass, or VIG for short? Think of it as a flat, transparent thermos bottle for windows. It is century-old, proven technology. First-generation VIGs have been commercially available for more than 20 years, but remain too expensive to achieve any meaningful market penetration. A V-Glass VIG is affordable and can insulate more than 3 times better than today's dual-pane windows. The problem is that buildings consume a huge amount of energy, and windows are the hole in the dike where most of that energy is wasted. Our solution? An affordable window as warm as a wall, as illustrated in this infrared image of 2 V-Glass VIGs in yellow. This image was taken on a January day in Wisconsin when the outside temperature was -4 degrees Fahrenheit. Notice that V-Glass is indeed slightly warmer than than the stud wall next to it. Also notice the 15-degree temperature difference between the dual pane window on the right and the V-glass VIG, which will make this room very uncomfortable for anyone near the windows. For the homeowner, upgrading to V-glass can reduce monthly heating and cooling costs by up to 50% and generate very compelling financial returns. Our environmental and economic impact will be significant. Full implementation of V-glass in the US could avoid 75% of carbon emissions and 90% of the energy wasted through windows, saving consumers $30 billion annually. Our unique product design is supported by significant intellectual property. 18 patents have been issued, 13 are pending, with more in the pipeline. Most importantly, V-glass can be affordably produced at room temperature, just like today's conventional windows. Here, I'll plot competing window technologies with increasing thermal efficiency moving left to right and increasing cost top to bottom. Clear glass and dual pane are relatively low cost, low efficiency. With triple pane, you get a little more efficiency for a little more cost. With first gen VIG, you get more efficiency at a lot more cost. V-glass breaks this cost performance paradigm by having the highest thermal efficiency of any product on the market, produced at cost comparable to today's conventional windows. V-glass is also 100% recyclable and has the lowest embodied carbon footprint. In the US, the DOE's Energy Star program rates the efficiency of various consumer products. The requirement for windows was recently raised by almost 25%. Current dual pane windows can't meet this new requirement. Triple panes can, but are thicker, heavier, more expensive to buy and to install. Building codes have already started to ratchet up in large parts of Europe and North America, which will ultimately drive demand for V-glass's affordable, ultra-high efficiency solution. V-glass is targeted at residential and commercial buildings globally, a $67 billion market. We will go to market using existing industry supply chains where we have established relationships. To be clear, we are a technology company that will license our IP to established glass manufacturers and window OEMs who will bring V-glass to market globally. To secure these licensing agreements, we must go through an industrial scale-up process where we move out of the lab into a pilot plant, demonstrate that V-glass can be manufactured at or better than our cost targets, and that it works in real-life environments, where we have already developed significant traction with more than $200,000 in order backlog and deep collaborative relationships with two large manufacturers, one in North America that's been supplying us with free glass since 2012, and a European manufacturer that will invest in our upcoming funding round. These are both platinum-level manufacturers, producing tens of millions of square feet of glass annually. Our EU relationship is progressing much faster, which makes sense given how much more expensive energy is in Europe. Based on precedent, we expect V-glass to be acquired by a large glass manufacturer in 2 to 4 years, if not sooner. We've accomplished all this with a very small technical team, all highly innovative problem solvers, named inventors on more than 200 patents. Our advisors have relevant industry experience and have taken companies from ideation to exit. On the right, you see numerous organizations supporting and collaborating with us, which allows V-glass to make a disproportionately large impact from a very small footprint. As a tech company, we will generate very high margins under our licensing model, targeting royalty rates of 5% in the residential market and 10% in commercial. We expect to grow rapidly once commercialization begins, generating operating profit of $20 million in year 6 on about 0.5% global market share, which could be accomplished without adding to the two large manufacturers already evaluating our technology. Today, we're raising $750,000 under a SAFE that converts at an $8.5 million cap or a 10 to 30% discount. This funding allows us to expand our technical team and begin delivering on our order backlog. To reiterate, I'm confident V-Glass could be sold today at a multiple of this $8.5 million cap. We're also in discussions with several investors about leading a $3 million round to begin moving out of the lab into a pilot plant. We've already circled more than $1 million to co-invest with the large EU manufacturer once a lead is found. This stage focuses on developing our proprietary manufacturing technology. During this 3-year period, we anticipate being awarded $1.5 million in public grants and expect 50% or more of all future funding to come from non-dilutive sources. That said, V-Glass will likely be acquired before most of our future funding is raised. I'll conclude with a few final comments. Energy drives the global economy and human flourishing. Affordable, ultra-high efficiency V-Glass is 100% recyclable, reduces carbon emissions, saves energy and money. Our value proposition is compelling without government subsidies, but with them, market adoption will occur much faster. I hope you'll join us in bringing our disruptive technology to market. Thank you for listening.
Hello, my name is Steve Okolo, and I'm the founder and CEO of LawNeeds Limited. LawNeeds is a UK incorporated legal software company, and the UK also happens to be where I am based currently, precisely in England, London. My educational career was completed in the UK as I started and completed my first degree in LLB Honours Law from Nottingham Trent University, and then proceeded to do my second degree in Human Rights Law, which was a master's from University of Nottingham, and my third degree, which was my second master's, was done at University of Westminster, and it was for Entertainment and Media Law. I've worked as a legal assistant at a law chambers in Nigeria, and I've also worked as a paralegal at an immigration law firm over here in London, UK. I'm a CPD accredited paralegal as well. All these experiences all contributed to my intention and my eventual implementation in regards to starting off LawNeeds. LawNeeds is a legal services software company providing personalized and affordable legal services on the go to our users. Through the LawNeeds mobile application, our users will be able to benefit from two things in particular. First being AI-generated legal advice. The LawNeeds mobile application shall be powered using artificial intelligence, and through our utilization of artificial intelligence, we aim to provide immediate and accurate AI-generated legal advice to our users, seeing as we shall train our mobile application on legal databases such as Westlaw and LexisNexis to ensure the accuracy and appropriateness of legal advice and assistance being rendered by our AI support assistant. This AI legal advice feature shall be immediate and shall help our users in regards to saving money and also saving time. The second thing which we shall be providing through the LawNeeds mobile application shall be user referrals. We shall be providing user referrals to both law firms and lawyers, and we shall be providing these user referrals to only SRA regulated law firms and SRA licensed lawyers. SRA standing for Solicitors Regulatory Authority, which are the regulatory body which regulate law firms and lawyers over here in the UK. These user referrals shall be location specific, as if a user is in London, they shall only get referrals to London lawyers or London law firms. The same thing happens if a user is outside London, be it Birmingham, be it Manchester, and so on and so forth. At our inception, we shall only be specializing in 4 areas of law: contract law, family law, immigration law, and road traffic offenses, also known as motoring offenses. Additionally, law needs will only be available to users in England at our inception, prior to scaling up the business and taking law needs to Northern Ireland, Scotland, and Wales on or before our 5th year of operation. There shall also be a separate section on law needs called Law Needs Pro, which shall be exclusive to legal professionals and shall assist them in select legal services such as drafting and proofreading of legal documents, alongside case management and legal research. All these legal activities shall be carried out on Law Needs Pro through our utilization once again of artificial intelligence, thereby assisting legal professionals in these day-to-day activities in order to foster productivity and also to foster efficiency. We aim to revolutionize how legal services are acquired and accessed in the UK, as from our market research, we noticed that usually when one requires legal assistance, the first place they go to is Google or any search engine of their choice, and they start searching, spending long hours researching for legal assistance. And this also comes with the pain points of also not knowing the competence or the qualifications of said lawyers which one might find online, alongside the pain points of frustrating wait times for legal services and legal assistance and the high costs of legal services. Law Needs shall be providing personalized and affordable legal services on the go to our users through our mobile application. Users are able to benefit from immediate legal assistance through our utilization of artificial intelligence. Hence, users will be able to save time and money through the utilization of Law Needs, where they can benefit from immediate AI-generated legal advice in addition to the referral features which we provide. We shall also have a search option whereby users can easily search for lawyers, and through the search option they can also get connected with lawyers who are not online on the Law Needs mobile application and send them messages, as lawyers will be able to put sample onboarding questions on their profile which users would have to answer to set up appointments on Law Needs. Hence why a product offering such as Law Needs is necessary. Our target markets will be young professionals, students, and anybody who seeks legal services.
Yes, nice to be here. I'm Peter Ringstaden, and I'm the CEO of Ligna Energy, and we are downscaling now to talk about energy and powering. So on the planet, digitalization is, and the development of Internet of Things drives the need for billions and billions of small wireless objects, connected objects, and all these objects needs to be powered. It requires a power source that has to be sustainable over time. So let's make super thin and sustainable wireless electronics. Starting out from hundreds of billions of units, first make them self-powered without any replacement needs, maintenance needs, no lithium batteries, and make also those objects super thin. And the way to do that is to combine a light cell or another type of energy harvester with a super thin storage component. And that's the selling points of our component from Ligna Energy, produced looking like this. Almost not possible to see because they are so thin, which is good. It's the greenest recipe, and it's at a competitive pricing because of a unique production technology. So we use no lithium, we use no perchlorinated acids, no manganese, Teflon, PFAS. So it's super safe recipe, and that's the origin of the company. And the shape of this one, since it's produced with printing and conversion technology, makes it possible to be actually now below 0.5 millimeter in thickness, which enables the end component to be super thin. So what can we do with this? Yes, here I have a self-powered example of a sensor node that you can put on the wall and no maintenance for 10 years. But the big thing is to make them small like this and thin. So this is a light harvester, our component on the back, and then the connected electronics so that we can, in this case, measure temperature and moisture maintenance-free with minimized material consumption. Other types of objects is trackers, sized like cars that you put on the parcel, and without any need for lithium batteries. A third example where we have actually a smaller version of this product is smart cars, where we have readers with reading instead of a code, you use your fingerprint, and then the card requires energy, and then you need to cut the card, and you can cut the energy storage. So looking into our focus segment, smart buildings, shelf label, smart cards, and asset trackers, we see a serviceable market of billions of units annually in just those three. We work in all these four areas with clients that are buying our samples and build their next generation products. And you can see display data and pricer, that's the number 2 and number 3 in the shelf label area. The impact is what drives us to go to work. So we have the most sort of sustainable component in comparison with others. It means 100 kilotons of savings. The self-powering principle adds on a factor 5 to that. But the big impact with these objects is that they are available for building owners and for the logistics sector, so you can get super heavy reduction in sustainability by affording these objects. So to sum up, unique material recipes and a unique production methodology makes these possible. So we have an open round now of 5 million. We have secured one of those 5, and I'm ready to talk to collaboration partners or investors at the booth. Thank you.
Hello, my name is Thomas Owings. I am a co-founder and the CPO at Blockguard Inc. Today I'd like to talk to you about a new business opportunity, as well as a brief introduction to Blockguard and what we are building. At Blockguard, we're transforming financial management with blockchain and AI technology. I had previously spent 10 years in traditional finance as a certified financial planner, had my own firm, and exited from that so I could concentrate full-time on Blockguard. Over my decade in the industry, I just ran into so many issues with traditional finance and the lack of innovation. And a couple of years ago, I fell in love with decentralization and really learned about blockchain technology and that there was a gap there where the two could be married together. The financial system's dual challenge with traditional finance, again, it's this inefficiencies when you're opening or closing an account, transferring assets, logins across multiple platforms. It's not a good user experience. A lot of things take time. And with blockchain, there's a technology to fix that. There's also a lot of high costs. I mean, they have brick and mortar stores have to pay for. They have a ton of different employees. And a lot of these fees, the user doesn't even know about. There's, expense ratios and overdraft fees and a lot of things from the banks and brokerage firms that just adds the cost to the user. And then there's a dependency on custodians. We've seen them go under before. I fully believe in self-custody. That's why we have to have FDIC with the bank. They could use funds in ways that could put them at risk. And we've seen that happen time and time again. Potentially could even get worse. With decentralized finance, there's a steep learning curve. It's a very complex and confusing type of product the first time you onboard some money onto chain and transfer between wallets, connect to different dApps. There's a lot of issues there. A lot of people fall for scams and rugs. So there are issues with decentralized finance. It's not perfect, but that's where we aim to make it a better place. At Blockguard, we are marrying the best of both worlds. So again, some of the issues with TradeFi that we want to get out of is the corporate custody. They can have improper use of funds. There's a lot of inefficiencies. So some of the good things with traditional finance is it's mature investment vehicles. Over 70% of assets in capital markets are invested in some type of diversified funds, mutual funds, ETFs, mutual or hedge funds. So people are used to and like diversified portfolios. Most people don't enjoy stock picking, picking individual cryptocurrencies. So what we're doing is building this decentralized, diversified portfolio. Now, another thing with traditional finance is they have some great tools, especially if you link up with the financial advisor. They have great financial planning tools like Money Guide Pro, eMoney, where it can really give you a good holistic financial plan, cash flow forecasting, set your goals for retirement, buying a vehicle, having a child, buying a home, whatever it is, and be able to track that and progress towards it over time. Now, some of the issues with decentralized finance we talked about, the scams, high barrier of entry, some confusing products. But again, the efficiency and transparency of it is unmatched to what you get in traditional finance. And so using these tools that we know from traditional finance with the efficiency of decentralized finance is all about what Blockguard is. Now, DeFi as a whole, we expect to see continue to grow. In 2019, it was basically zero TVL. Over the last 5 years, we've seen it go to around 100 billion, and we expect that to continue to grow, topping at 200 billion here in just 2 years. To get there, we expect that to be a 45.6% compound annual growth rate, and that's based off a lot of different resources we can send you. So if you're looking at the DeFi TVL currently, talking slightly over 100 billion, while the global total asset under management is almost 100 trillion. That's a massive opportunity. Now, we're not saying we're going to get a piece of, the 100 trillion, which we will, but we're going after targeted sectors and markets to slowly, as this adoption continues to grow and grow, we want to be that soft landing spot for folks to have a good, safe, diversified investment management platform. Some of the competitive analysis in DeFi, you can see the Aave and Lido. We'll have our own wallet, so competitors with a MetaMask. In traditional finance, it's more of the Robinhood, a custodian that has some really cool, innovative tools that a lot of the younger generation enjoys. Also, Mint has great budgeting tools and financial planning techniques that a lot of people integrate. What we want to do is have both of those combined to make Blockguard. Now, how we're doing that, we have 3 different product lines. So Fusio is going to be our decentralized exchange. It's going to launch just with diversified portfolios. It's going to be sector specific, such as AI, memes, large cap, mega cap, small cap, micro cap, lots of different areas that it can be in, and it can be diversified across 30 or so coins. Portfolio Pro is going to be our digital wallet and financial planning tool. It'll automatically asset categorize the stuff on your wallet. You can also manually input off-chain assets. It'll have cash flow forecasting. It also allows advisors to remote in, have limited access, which we think will be a game changer in the space over time. And lastly, Blockguard Network is going to be our layer 1. It has zero knowledge proof, IBC technology, but it's also going to have very innovative and the first of its kind multi-authentication on chain that's built into the smart contracts. Revenue for Fusio, it's based off the transaction fees. For Portfolio Pro, there'll be 2 different levels. The B2B going to advisors at $300 a month. B2C will have a freemium model. Now, on top of that, if you want some of the extra AI tools for financial planning, it's a small $10 a month, get a lot of discounts and whatnot. And finally, Blockguard Network, the largest source of revenue, will be from transaction fees on that chain. So here's the team, just real brief. Anthony Bevan, I have known each other for coming up on 3 years. He's very well versed in decentralized finance, where I take over a lot of the traditional finance experience. and we have a very great relationship. He's a very hard worker and has a great vision of Blockguard. Anthony Zaroli, he's one of our co-founders and the COO, also has a lot of entrepreneurial experience and does everything behind the scenes to help us make sure we're operating smoothly. And then Daniel's our CTO. He has a master's degree in blockchain and cryptocurrency, and a very smart and strategic person that has already helped us tremendously. That is the presentation. I will wrap up by saying we have completed our pre-seed. That was for $550,000 in cash, along with about $420,000 in development work for equity. This is our seed round. We're doing a $2 million safe that will offer a 20% discount on the future valuation, along with a max valuation cap of $30 million. So thank you so much for your time. If you have any questions, you may always email me at thomas@blockguard.org. Thank you.
Hi, I'm Amy. I'm CEO and co-founder of the First Element Group. We are a consumer-facing, hydrogen-enabling business, and we're developing a small portfolio of innovative products to revolutionize the way that hydrogen is being created, used, and stored. We know from the Hydrogen Innovation Initiative report of April this year that the global hydrogen economy is set to reach a staggering $8 trillion by 2050. And this is driven largely by many governments' commitment to hydrogen as a key. We know that the focus has been predominantly on large-scale industrial projects, and the capex for these projects is huge and the lead times are long. We think we're overlooking a huge potential group of hydrogen users, and these include off-grid residential, light industrial, agricultural, leisure and holiday, consumers for whom direct use of electricity and technologies like heat pumps is going to be impossible. They're on single-phase electricity and upgrades of infrastructure are unlikely. They are currently relying on bottled LPG gas for their heating, cooling and cooking needs. So the First Element sees a different way, a complementary way of tackling this big problem of meeting these ambitious net zero goals. And we're looking for a clean hydrogen solution that can be a direct replacement to an LPG canister. So with the help of Innovate UK, we've designed and built a prototype end-to-end self-generating hydrogen smart tank. And it can safely generate and store hydrogen at the point of use, wherever an LPG canister is currently being used. The smart tank is a little mini factory, and through a process of electrolysis using an input of water and renewable electricity, either from a co-located solar array or similar, or indirectly via the grid, you simply add water, renewable electricity, and you can generate your own gas where you need it, in the quantities required, and when you need it. This gets rid of a complex and polluting distribution network. It puts the power back in the hands of the consumer, and the smart technology on board allows the consumer to manage their inventory, their production inventory, and of course the key safety features of the device. Each of our tanks will mitigate 3,320 kilogram equivalent of CO2 over its lifetime. Spoke of a small portfolio of technologies. You see here our prototype smart tank and the user interface on the smartphone app. This will control time of charging. It will allow you to draw down when electricity is at its cheapest. In some cases, that's been entirely free or cost negative over the last several months. And you will also see a hydrogen sensor. The metering and monitoring market for H2 is set to reach $6 billion by 2050. And in the course of our development journey, we were looking for a low-cost, IoT-connected smart hydrogen sensor that could sit around the generating device and any appliance being used for it, so that it could detect any leaks and ensure shut-off, both mechanically and using the software. What we discovered is that the sensors currently being produced, sold and used are of course suited to industrial and lab-sized projects. So they are highly spec'd, power hungry and expensive. There is a big market opportunity for a low-cost hydrogen sensor, a little like a smoke alarm. There is an existing market for those already developing using and distributing hydrogen, and that market will only grow as hydrogen takes its rightful place in the alternative energy mix. So we set about creating our own device. This will be an integral part of the smart tank, but also can serve as a standalone product, which we can bring to market sooner and ideally get our name, the first element, and brand synonymous with hydrogen safety. We've recently won an Further Innovate UK grant to pre-commercialise this hydrogen sensor opportunity. Innovative electrolyzer technology has obviously been a part of our supply chain journey exploration, and we have an exciting partnership with Professor Prakash Ghosh of the Indian Institute of Technology in Mumbai, who's working on a low-cost alkaline electrolyzer that could be something we could use in our smart tank, but that also is going to be used in a clean cooking solution using hydrogen that will replace the need to gather and burn solid fuel, coal, wood, etc., for 1.1 billion people. We're also exploring the idea of the hydrogen smart tank being used as an in-house or in-depot refueling device for hydrogen vehicles. These have been hampered by terrible refueling infrastructure, and we think that the tank, using the hydride that we use for storage as a compressor, could be used to create a device that could add up to 200 miles of range to a vehicle whilst it's at home or in depot overnight. We know that the hydrogen opportunity is going to be huge. Switching out just 10% of the LPG gas canister market for a smart tank would give a sum of 220 million. And this is without considering the hydrogen sensor market and a number of different beachhead markets that we identify on the slide here. To introduce the team, I'm Amy Hedger. I studied modern languages at Oxford and then Mandarin at Leeds. I worked as a C-suite consultant to global consumer brands, including Nike, Apple, LVMH, in the context of emerging global consumer trends and sustainable design practice. And I helped bring a number of different products and built space environments to fruition. Professor Nigel Brandon is our chief scientist. He is Dean of Engineering at Imperial College London and a globally respected hydrogen expert. Greg Howitt, our CTO, is a robotic engineering graduate and a founder and successfully exited entrepreneur, and has been working in edge computing and software development for the past 25 years. James Brandon and Steve Samuels make up our technical team, James as our hydrogen and fuel cell engineer, and Steve Samuels as our head of software and control systems. We're also incredibly fortunate to be supported by an advisory board. We have Professor Oliver Kernick of Coventry University, who hosts and supports our lab and exploration work at their state-of-the-art Sea Alps hydrogen facility. Professor David Grant of Nottingham University, who heads up the hydride team and with whom we're working on our novel metal hydride storage solution. Sam Simpson, who's also a shareholder, a serial successful entrepreneur, and is helping us in our fundraising efforts. And Alison Masters, who is CEO of an award-winning B2B marketing agency and will be helping us with our go-to-market marketing strategies. And to date, we've gathered together what we believe is a really high caliber team. We have lab space and an advisory team at Coventry University. We've been awarded SEIS and EIS Advanced Assurance. We've won £185,000 in Innovate UK grants, and also investment of £100,000 from Next Energy Capital. We've built TRL4 prototypes of both our smart tank and hydrogen sensor technologies. We have letters of support from Bourne Leisure, who own the Haven Holidays brands and are the biggest single user of LPG bottled gas in the UK, and looking to replace those LPG canisters with a possible alternative fuel solution. And also Netflix, who are looking at a possible decarbonisation project for their film sets. We have a partnership with Nottingham University's hydride storage team and a number of different collaborations globally with innovators in the electrolyzer and fuel stack technology space. We're engaged with the leading caravan manufacturers in the UK, as well as their suppliers of heating and hot water solutions, and also with leading hydrogen vehicle manufacturers, Professor Ghosh of IIT, of whom we spoke, and we are about to test with one of Europe's largest boiler manufacturers who are developing a hydrogen-ready boiler. Lastly, we were very proud to be part of the cover feature of November 2023's Engineer magazine. We're currently looking to raise £500,000 and we have full SEIS and EIS allowance still available. To date, we've raised £185,000 in grants so far, so in non-dilutive funding, and £100,000 in equity investment from Next Energy Capital. We will be looking to apply to any and all future grants with the aim of increasing our non-dilutive funding. Aims and expenditures. We aim to move all of our prototypes forward. We want to continue to build our relationships with other innovators and suppliers. We want to raise our brand and product awareness and to get this hydrogen sensor to market. And we will also be further developing our hydride storage solution in partnership with the University of Nottingham's investment team. We will, of course, also be ensuring that we protect any and all IP that we're generating. We look forward to hearing from any interested parties.
Good morning, ladies and gentlemen. Thank you for taking the time to view my presentation. I really appreciate it. I will kick off with a little bit about myself and the team, because I think it's very important for an investor that you don't only invest in the project, but also in the team. The team, I will start with myself, Marco Goemans. I started 25 years ago with a career as entrepreneur. Through all my career, I have everything to do with warehouses. We were building them, flipping them, renovating them. Since 2018, we were already doing business in Dubai, and in 22, we decided to make the move and move the business over to Dubai. So in 23, we started up our first company, and for that, we are looking for an investment. I'm starting with the team. So the first one is the CFO, Christian. Christian has his own accounting firm in Dubai for the past 5-6 years, and temporarily he will be the interim CFO for our company to set up everything and that everything goes smooth. Then we have Shalini. Shalini will be the director manager. She will be the spider in the web, connecting everybody and keeping track of daily operations. And then we have Faisal. Faisal is our head of marketing. His specialty is building something from scratch to something beautiful, and that's exactly what we need, because we are a startup and we're going to start from scratch. Then we have Debbie and Marielle. They are from the team from the Netherlands, part-time. They do financial payments and accounting. Then we have my assistant Vera. She's helping me in the Netherlands and supporting the team in Dubai. Camillus is a good friend of mine. I know him for 15 years. He knows everything about warehousing, building, dismantling, renovating, everything. When we have projects in Dubai, he will fly over and help us with the projects to manage. Then we have Hannelore. Hannelore is my advisor in the Netherlands. She's the ex-CEO and she's helping me setting the short-term and long-term strategies. That about the team. Let's go to the projects. The projects. In the last 6 months, I have visited several projects. We have now selected 3 of them. One is in DIP. It's a new build-off project. It's an industrial compound of 20 units, office space, showroom space, and warehouse. Then we have NIP. It's an industrial compound of 4 buildings, 24 units, fully tenanted, very good maintained building. I also selected a project in Jebeli Port. It's a steel factory. Why did I select it? Because there is a very big plot. So that's very nice for in the future. So we can invest and maybe build another warehouse on this location. So at the moment, we are looking for a proceed investor. That means that after we receive the funds, we will open up the office in Dubai. We will make the company operational. We will hire the staff, buying software, hardware, valuators, brokers, set up accounting, of course. When the company is operational, then we can really start with the projects. For that, we need the proceed investor. So for the UAE itself and Dubai, I think the government is very stable. Also the city, Dubai, it's very safe. And then we have, of course, the tax regulations. I'm from the Netherlands, so here they keep changing the tax regulations. At the moment, we pay corporate tax 54%. That's crazy. In Dubai, we pay 9% corporate tax. Also for the staff members in the Netherlands, they pay 30-40% tax on their salary. In Dubai, you pay 0% tax on the salaries. So I think it's a very good environment to open up a new company. So the investment rounds, what I told you, we are now looking for a pre-seed investor so we can make the company operational. At the moment, we have the company operational. We can move on to round two. Round two are the projects. We already selected 3 projects. For those, we are looking also for investors. So when you're interested in those projects, just send us an email. We will send you the presentation so you can study it. For round 3, we already started developing and drawing a industrial compound of several buildings. So that will be a project we are developing ourselves. And as we are growing, we are targeting to build a company between $100 and $200 million in the next several years. Important thing to mention is how are we going to pay you back? When we do round 2, there will be coming more capital in. So with that capital, we can repay you back. And also when we have persecuted the first projects, the revenue will come in. The tenants have to pay rent for the business units and the properties they are renting. So it will be a short-term loan, maximum 24 months, but probably we can repay you back in 12 months. So for in the future, of course, we will have some Zoom calls. We have to set up the contracts. At the moment, we're gonna do business. We will keep close contact with the investors. Some investors, they just invest the money. Some investors, they want to keep informed. Of course, we will do every 30 days a report. We will report what we have done in the past 30 days. We will report what we're going to do in the next 30 days. Also a financial report. We will send you every 30 days a financial report. When you want to keep in contact, we can do a Zoom call, we can text, we can email, no problem. Also for in the future, round 2, round 3, we will also discuss that with you guys because it is important that an investor knows where his money is spent and how he will be repaid. I'm a long-term relationship guy, so I hope when you decide to invest as a pre-seed investor, we can do a long-term relationship and we can take you to round 2. So we're coming to the end of the presentations. Again, thank you for taking the time to viewing it. We are here standing by with the team. When you need any information, please send us an email. I'm open for a Zoom call to discuss the projects and the terms. Please contact us. Thank you for your time, ladies and gentlemen.
Hello, I'm Ivar Serenis, founder and CEO of Roadbird. Today, I'm excited to share with you how Roadbird is transforming the rideshare industry by ensuring compliance, enhancing efficiency, and improving driving profitability. The rideshare industry is facing significant challenges with tax avoidance and compliance issues. Annually, 7.8 billion in taxes are avoided in the European Union alone, leading to heavy fines and liabilities for platforms and fleet operators all over the world. At Roadbird, we understand these challenges. Our platform is designed to address these issues head-on, providing fleet operators with the tools they need to be compliant and profitable.
Our proprietary AI and IoT technologies automate compliance and optimize fleet operations, resulting in earnings up to 3 times higher than the industry average, with 70% less time spent on payroll and compliance tasks. Our technology is also easy and cheap to integrate, ensuring a painless deployment process without disruption to the business.
After a year of real-world use, our platform has proven its value. We have processed over 800,000 euros in transactions with our pilot fleet in Stockholm, Sweden, demonstrating efficiency and growth. Our driver app is designed with user-friendly interfaces that makes it easy for drivers to track their earnings and comply with regulations. Our goal is to create seamless experience for both drivers and fleet managers.
Like that you can send in all the receipts and stuff digitally. It's super easy, and that saves a lot of time and administrative work. Like you don't have to do so much of that boring stuff. You can focus more on driving. So that's really great.
Jag tycker det är jättebra. Man känner sig så här, man kan tävla. Förstår du? Det blir som en tävling. Man vill vara först för man vet det finns en bonus. Och när man får den här bonus man blir motiverad på något sätt. Man får motivation. Jag tycker det där är jättebra faktiskt. Så det blir som en tävling i gruppen liksom. Alla chaufförer som jobbar med Roadbird. Och det är bra för båda chaufförer och för Roadbird själva.
So this is the dashboard for the fleet managers. So here we can see how much revenue were generated under Bolt, and here we can see how much revenue were generated under Uber. These are driven kilometers on each day. It is the count of the cars, count of the drivers, which are operating them. This is the efficiency metric, which we have tracked on daily basis. And here we have average revenue per cars, and here we have how much exactly each car has made in revenue for the fleet operator on that specific week. And if we select the month, for example, July, here we can see how many cars have been active, how many drivers have been operating them. And now where we can see the drivers which are linked with our cars. And here we can see the cars which we have under Desert Fleet Operator. And here are revenues of these are net revenue. If there are any efficiency adjustments, they appear here in July. And here is the fleet operator report. So you can see how much every car has been making every week. And here we can see all their reimbursements, or reimbursements were activated in the beginning of August. And here we can see all of these reimbursements which has been processed. So I, as a fleet operator, can see every transaction here. And if I got it to the picture, I can see also the receipts. The payments are handled automatically by the platforms. Other is no need to worry about payments processing that is done by the platforms. And if the fleet operator finds something which he wants to challenge or which he disagrees with, then there is possibility to challenge this. So you can write a comment, I disagree with this transaction, or this receipt looks faulty, or anything, and then the transaction can be challenged and reversed. Here we have also all of the receipts which has been processed by the platform, each car, each amount, and full details for these receipts which has been processed.
Now here they can see their efficiency, their weekly goals. Here the drivers can access their salary reports. So they are very detailed. They can see all of their earnings, how much they pay in different fees, how much they pay in taxes, and all of their payouts, and also all of their tips, and also all of the salary adjustments if there are any. And then they can also see reimbursements which they have received, and they also can see all of the advance payments. if they have taken any advance or credit payments, they are also included here in their salary report. Here they can see all of their earnings and also all of their payouts transactions. This is the reimbursements menu, and here they can see the reimbursements which they have requested, and if they have been processed, what's their status are, and they can request new reimbursements there. And here they can do the withdrawals from the app. They just have to enter the amount to be withdrawn and press the button, and then they receive the amount into their bank account directly. That was Swish notification, which means that they have received the money already. And here are all of the cars which has been linked with their accounts.
Roadbird was created by rideshare drivers and fleet managers for rideshare drivers and fleet managers. Our team, consisting of industry insiders and experts, is dedicated to making the rideshare industry sustainable and profitable.
Our team has decades of relevant domain and industry experience, and we are committed to driving change and ensuring the success of drivers, fleet managers, strategic partners, and governmental stakeholders. By leveraging our extensive network and our industry knowledge, we strive to develop innovative and easy-to-implement solutions to solve complex compliance and operational problems within the rideshare industry.
With strong tailwinds from regulatory enforcement and mounting demand for compliance from transportation providers like Uber, our proven technology is a timely solution for a range of emerging challenges that will define the industry's next big winners and losers.
We seek strategic partners and smart money investors to join us on this exciting journey. By partnering with us at this juncture, you will get in early to help us achieve key milestones, including expanding our fleet, entering new markets, and enhancing our artificial intelligence capabilities. As we achieve these milestones, of course, this will also create significant shareholder value and position us for future growth and expansion.
Your investment will expand our runway and enable us to achieve these milestones, ensuring that we continue to lead the rideshare industry in compliance and efficiency. With your support, we can continue to develop our platform, enhance our technology, and expand our reach to more cities and countries.
We invite you to join our ride. Together we can transform the rideshare industry, ensuring compliance, enhancing efficiency, and driving profitability for all stakeholders. Your support will help us bring our innovative solutions to more markets, improving drivers' lives and fleet managers' operations everywhere. Visit us at road-bird.com to learn more. To book a meeting and discuss further, message us directly through CapitalHQ.
Hello everyone, my name is Fabio Lettieri and I'm the co-founder of IP Capital Fund. For the past 25 years I've been working with IP, patents and brands and licensing. Our project is based and focused on licensed IP, and we touch different sectors of the market, from AI to pets industry to road safety. Today, IP Capital has 8 patents in its portfolio, 2 of which are in negotiations with major companies based in UK and US. And our goal is to raise an additional 2 million euros to complete the rest of our portfolio. IP Capital Fund was based in 2020. I was one of the first investors in the project, and our business model is very unique because we buy ideas that have a potential in the market. We make the prototype and the production of these ideas in Asia in our platform, and then we license to either mass retailers or strategic partners around the world. I would love you to take a look at our two projects that are today ready to go to market. One is the paper tablet and one is the V16 Holo. So enjoy the video, and I look forward to you either via Zoom or in person to give you more details about IP Capital Fund. Thank you very much for your attention and have a great day.
All right, welcome guys. It's a pleasure to have you guys on Capital HQ. And the purpose of today's call is really to dive deeper into a report that you guys both put together, the BDO and Focal Venture Fundraising Landscape Q3 2023. So if Adam, if you'd like to introduce yourself.
Yeah, sure. Hi, my name's Adam and I'm part of the growth advisory team at BDO. We are specialist earlier stage advisors helping companies raise both debt and equity, post-seed up to early Series B. We're a mix of both advisors and former investors in our team. So we believe that uniquely in the market, we've got a really strong investor lens when we look at opportunities. So the companies we talk to and work with are best prepared to hopefully increase their chances of a successful raise.
Fantastic. Maybe Jack?
Yeah, absolutely. I actually couldn't agree more. On the BDO side, been fantastic partners to both us, but also a number of companies that have gone through Focal. So I'm one quarter of an organization called Focal. We're essentially a central data exchange for early stage fundraising. So we were formed about 3.5 years ago by two quite senior members of the VC ecosystem that decided the process of raising funding was completely broken and very opaque, very relationship driven, predominantly favored that of the well-networked or very community-led individual and founders. So we started tackling that problem. We have a biannual demo day, which is certainly probably Europe's largest, and we're kind of bridging on now, hopefully, with global expectations and ambitions. We see about 4,500 early stage companies every single year. And we systematically invest into 2 to 3 companies that go through each demo day by SPVs. So we've co-invested with likes of NTBC, Lightspeed, Boulderton, etc., and have facilitated, I think, of last demo day about 7,500 introductions between both VCs but also founders.
Fantastic. And I think hopefully today we can get rid of some of this opaqueness with this report. And for anyone who's watching, in the description is a link to that report. And the questions that will be asked today and answered, and the discussions will all revolve around that report, as well as expand on it. So I think first things first, maybe one of you can answer this to start with. Considering the trends highlighted in the report, how is the dynamics between investors and startups evolving? And as a follow-up to that, what key strategies should startups adopt to navigate this evolving landscape?
Okay. If you want to take that one, Adam.
Yeah, that's fine. So I think leaning on what Jack said before, is we also firmly believe that there should be more transparency in the ecosystem, and companies should be able to, if they're well prepared and well researched, to be able to go out to investors with a good proposition and be able to get a meeting. And by that, I think it works both ways, that when founders reach out to VCs, they should get a response with clear reasons why the investor wants to or does not want to take up a meeting. But also founders really need to do their due diligence, that they are going out to relevant VCs sometimes when we speak to companies and they say, oh, I've been out to a few investors and I'm not really getting much traction, and we look at a company doing 10K of MRR and they've reached out to investors that clearly say on their website they only invest in businesses that are doing 2 million EBITDA upwards. So they're not going to get a response because investors will just look at that and say, you haven't researched this properly, you've got no credibility, I'm not going to respond to you. But more widely, I think it's becoming more important for founders to give themselves more credibility by not only knowing their business really well, but also knowing the whole landscape of businesses that they compete against and how the market that they're operating in has changed. Because not only does that give more credibility to the founders, and especially at an early stage, I think it might come later in one of your questions, but it definitely comes through in the report. Founders are the most important thing for early stage investors. So knowing your company and your market really well shows investors why you are the standout pick in your market for them to invest in. Because what you have to realize is very few investors, if any, can have two competing assets in the same portfolio. So what you're convincing them of is this is a really good market and you should invest in it. But also we are the best asset in that market for you to invest in. And the reason we know that is because our KPIs are better, our management team's stronger, our traction is quicker, etc., etc. So knowledge and being prepared. I think you'll find that me saying being prepared might be a recurring theme throughout.
Fantastic.
Yeah, absolutely. And I couldn't agree more on the investor points. Often VCs, forgive me if any VCs are actually tuning in, but are often quite fickle individuals. So as a startup, it's paramount really to, like, first impressions matter, is kind of what I'm trying to say. And often from an investor outreach point of view, there's only kind of one bullet in the revolver from a chance point of view. From exposure to VCs. So first impressions matter and they last. So it's kind of pivotal to make sure that you present yourself as a founder in the best possible light, whether that be to take formal advice from an outreach point of view or to structure a financial model if you're a late stage company that reflects the VC's growth expectations. So all those things come into play.
Okay, fantastic. And I guess moving on to the next part of the report in terms of venture landscape and dynamics, investor dynamics. So it's reported that 42% of investors require investments to qualify for VCT or EIS funding. Apart from the tax incentives, why do you think this is, and how does it shape investment strategies? So that's first part. And how should startups navigate this landscape if perhaps they don't qualify for it, or what steps should they take to make sure they qualify for it?
So I think that the first thing to mention is that the reason that question is in the report is to set the theme for the rest of the report, so people know where the answers or the type of investors that are answering these questions. And I think what you'll find is with EIS and VCT investors, the background really to that is, if you kind of think, without being too stereotypical, UK personalities versus US personalities. UK personalities are more risk averse naturally. The background of a lot of the VC ecosystem in the UK, because it hasn't been going for as long as in the US, is more kind of private equity type mindset with a bit more risk. So those EIS and VCT aids allow the funds to take more risk, and then therefore allow them to say, we can invest in companies that are more loss making for a bit longer than our counterparts in private equity. And that's really helpful for earlier stage companies. And I think it does make it more difficult for companies that don't qualify to raise money in the UK. But I think if you consider why that is, most companies that VCs will want to invest in are high growth, early stage UK based companies. And the reason for that is, despite what we're doing now and having a virtual phone call, VCs do want to know that if something goes wrong or they need to, they can just get in a car, get on a train and go and speak to the management team in person and try and help them, because VCs, although people do give them a bad name, do want to be supportive, because ultimately everyone has the same goal, to get a nice return for management and the VCs. So I think what is important is when you are looking for your first round of investment, or you're coming through to the 5th or 6th year, without going into the details of the EIS and VCT rules, is to really understand and grasp those rules, to know how to keep your company EIS and VCT qualifying, because it does just open a lot more doors and give you a lot more options for funding.
Right. And
yeah, absolutely.
Yeah. Sorry, Jack, did you have something to add?
Yeah, I think just like a takeaway tip, really. There's obviously a thing called EIS Advanced Assurance. So if founders are thinking about going out to raise through the EIS scheme, which, as Adam rightly said, is massively beneficial from a UK investor point of view. And I think having proper legal advice that you can actually rely upon to go out with that assurance is sometimes very advantageous. So we work, or have worked quite closely in the past, with a law firm called Philip Hare, which is a specialist EIS law firm. And so for any founders out there, I think thinking about that sort of strategy, it's important to get proper legal advice. And I think those guys are really good at what they do.
Yeah. Okay. Those are some good tips. In regards to, Adam, what you've mentioned in terms of the more risk aversion mindset, have you seen a trend where it's getting more risk averse or less risk averse? And obviously the last 2 years probably has seen more risk averse, but in general, the UK landscape, what's your opinion on that?
So it depends how you look at risk. I think the biggest change in the landscape has been how long investors allow or will tolerate cash consumptiveness in a business. They want to see a pathway to profitability sooner rather than later.
Yeah.
I think if you look at those like Series C, Series D raises, they're the ones that have really fallen off, because most VCs now think that the companies that struggled the most, and the bigger companies that were really the big failures through and out of COVID, were those ones that were still loss-making, having had hundreds of millions of investment. So I think Series A investors especially are now turning around, and we've asked the investors these questions, that where previously Series A investors would say, look, if you're not profitable in 2 years, that's fine, but as long as you start to get profitable within 2 years, we really need to see that. Now it's a lot more like 17, 18 months. We don't want to see heavy loss making throughout. And effectively what that's saying is we want to see a structurally profitable business model, that the longevity of the company isn't just dependent on spending more money on marketing, winning more customers. Do you have profitable customers? Are you running a strong company? So that if some other crazy macroeconomic event happens, then it's more savable, that we can keep the company going through that period. The company won't need massive investment to support, investors won't have to support their own portfolio with massive investment just to keep those companies running.
Right. And I think, based on that, on the follow-up of that, either one of you can take this on, but it's noted in the report that most Series A investors expect a company to become profitable within 12 to 24 months post-investment. From an investor's perspective, how realistic is this expectation? And from a founder's perspective, from a startup's perspective, what steps should they take to meet these profitability timelines?
I can take that one, bit of a tongue twister. Yes, obviously now that startups are being launched, I think with leaner fundraising environment in mind, obviously DD periods from investors are taking a lot longer, and they're kind of mitigating. Those are now perceived quite risky or riskier investments than previously. Teams, which is obviously a huge proportion of overhead, but other overheads, I think, are being kept smaller for longer, which means that profitability can be achieved at a quicker rate. I think obviously there's an offset with growth here, with VCs revising down their growth expectations to account for better inverted commerce profitability. But there's also a great focus on, I think, organic customer acquisition channels, customer retention, and especially from a consumer perspective. And so all in all, I think having to be much more strategic about growth and not just targeting everything and everyone, like they were, or possibly more so anyway, 1, 2, 3 years ago.
Right. And maybe follow up, and this is what impact does a higher focus on profitability maybe have on the rate of innovation then within this UK ecosystem?
I'm not too sure if you want to take that one, Adam.
Yeah, I don't mind. I think that I think it just goes back to what Jack says, that it drives more focus from management teams. If you're not trialing loads of different routes to market, loads of different products at the same time, and you have a focus to say, all right, we're going to launch this, and then we'll launch this module, and then we'll launch this module. But keeping in mind that you're not just going to go out and try and win 10 customers straight away with whatever you've got, and then you've got to maybe rebuild the tech because those 10 customers, it doesn't work for those 10 customers, and you've churned 80% of that. Hopefully, does that answer your question?
Yeah, absolutely. It's and then in the report, the average minimum founder equity stake expected by investors at different funding stages was mentioned. The numbers evade me, but I'm sure you guys know them. How does this expectation influence founder decisions, and especially considering company growth and how much they're supposed to give away?
Yeah, I can take that one. I think it's a dark art, really, and it obviously involves quite a lot of negotiation. Yeah. It's about realistically a baseline, finding a happy medium for both of the parties mentioned. I think it's a famous saying, I'm not too sure who said it, but no amount of friendliness can change the fact that every single cap table adds up to 100%. I think if you put yourself in the investor's shoes, I think investors obviously look for founders to be incentivized round on round, right? And that's probably most important for them, beyond obviously their equity stake. So if you're a Series A company with 2 founders, for instance, collectively owning 30 to 40% of the business, an incoming investor will look for a share option pool as a part of that as well, which is often probably vested across multiple years of the cliff. And vesting periods are crucial to VCs to make sure that founders are sufficiently incentivized. I think founders often forget that equity is an unbelievably expensive form of financing. So maybe we can come on to a bit of strategies and how to kind of balance and meet demands and supply. But yeah, I think from a strategy point of view, in terms of how to balance that equity retention piece and investor demand, there's now short-term and long-term debt options, which are often hybrid mixed with equity. So venture debt, which is often like an 8 to 12% fixed interest rate, often most popular with Series A companies. We see quite often. I think some VCs are very ownership sensitive, some aren't. I think the latter are very common at the very early stage. So for instance, you have an LP VC driven fund here in London called Cocoa, which is led by an amazing female entrepreneur and investor called Carmen. It's a micro VC, so that's $17 million. She, and these are her words, famously doesn't give a damn about equity stake, really. I think if you consider what pressure she's under from above, LPs, especially the more institutional players, are putting pressure on GPs because often they want to see consistent ownership within their particular funds into companies. I think there's obviously, in that particular case, not often a huge amount you can do to control that as a founder. And it's about finding a situation that works for both parties, like I said. And I think that derives from a level of transparency. So for instance, before signing your term sheet, I think discuss things that are going to be thrown into the equity compensation. So like a share option scheme, for instance, your potential investor, make sure that that's negotiated fairly. I think as a founder as well, make sure that you don't fall victim to the share option shuffle, which is essentially putting the option pool in the pre-money valuation, which is diluting the existing shareholders and yourself as a result of that. And basically just don't undersell yourself. Like the opportunity cost of an incentivized workforce from a share option plan point of view, at the expense of diluting shares is one that investors understand, and you should be appropriately positioned for that to really motivate a workforce of yours, really.
Great.
Then the only other thing that I'd add to that is that equity stake point is a really good sense check for founders in terms of their valuation and how much they're raising. Because again, goes back to founder credibility, that if you're going to an investor and saying, I want to raise X at an X valuation, and the investor looks at it and they might say, look, I'm only getting single digit equity here. I'm not even going to carry on the conversation.
Yeah.
So having a think about that 15 to 25% or whichever stage of investor you're talking to, as to do you think that's a reasonable amount of equity that they will want, not just that I'm willing to give away, that would incentivize them to want to carry on the conversations. And if it isn't, am I looking to raise too much, or is my valuation too high?
Yeah, makes complete sense. And before we move on to the next part of the sector trends and sustainability, I'd like for both of you to maybe give one piece of advice to founders currently raising capital. Just the one biggest piece of advice, and perhaps the current climate.
Not too sure if you want to go first, Adam.
Yeah, I don't mind. I think that look, the fundraising process as it is effectively a full-time job for founders. And the difficulty in that for founders is that they are usually operating in a high-growth business, and they are a central cog to that business continuing to grow. So if they take on another full-time job, the business is very unlikely to grow at the pace that it was growing at, and the wheels might even fall off. So if you end up going into a VC process and the business is growing, and 2 months into discussing an opportunity with the VC, and they might be about to put funds in, and they ask for your most recent figures, they'll look at them and say, wait a second, you're not growing at your 10, 15% MRR, you're growing at 2% MRR. What's going on? And if the founders say, well, it's because I'm doing this fundraising process, the VCs don't care. So it's about really understanding that it is a second full-time job. Advisors, of course, unbiased, do help to do that. But even if it means bringing in some fractional support, whether it's a fractional CFO, an NED, anything that can help you through that process, and you really have to understand that how time consumptive it is to fans that already have really short bandwidth.
Yeah.
Absolutely. I think echoing what Adam said as well. I mean, if you're not going to go down the third-party routes, I think it makes sense for a lot of companies, especially at the late stage, A and B in particular, where ultimately you have more stuff going on as a founder, quite simply. It's just to stay in the saddle. Like ultimately, the higher quality startups are still getting funded, and there is a supply of capital out there, be it quite a lot of it is dry powder currently. It's a volume game. So ultimately, 90% plus of the replies that you're going to have from VCs, whether you have a conversation with them or not, is going to be a no, unfortunately, just to set the baseline. But they're in the business to say, that's quite literally their full-time job. But it takes a very relentless individual, one that I wouldn't really ever want to aspire to, just given the massive effects that it has on running your business, but also on your mental health, I would say. But yeah, like I said, it comes down to the higher quality startups that are still getting funded. It's just a matter of when and who from.
Yeah, I think one of the biggest tips I've heard in my 2 years with Wholesale Investor is a founder should always be in capital raising mode, as in they should never not be. So even if they've completed their round, they should still have this mindset, because it's a lot easier to keep going than to restart for the next funding round. Keep those contacts. Even if you're not raising, go once or twice a week to meet investors and just keep them in the loop. I think that was one of the biggest pieces of advice I heard, and I've reproduced that a couple of times to certain founders, and so some of them have taken that up, and I can see that obviously their first fundraise is always so long, but the ones that keep going, and I've worked with them for the second fundraise now, it seems like it's a lot easier to keep that going. So I think that for me was one of the biggest tips I've taken and given to certain founders.
Yeah,
absolutely. Sorry, go ahead on.
Then I was going to say that it is a very good strategy, and I definitely agree that I think that if you are doing that, the numbers that you share with those VCs that you want to do further rounds should be numbers that you believe are definitely achievable. Because if you send out numbers which are shooting for the moon numbers, the VCs will always come back to those numbers. And if for some reason you haven't hit them, it's going to be very difficult for those VCs to turn around and not say, well, you said you were going to be doing X of ARR and you're only doing X. So can you come back to us when you get there? And maybe things have changed. Maybe you just were too aggressive with the numbers you showed them. So it's always good to show the numbers that you think are attractive to them, but also numbers that you can at least meet, but even better, surpass.
Yeah, absolutely. I think instead of, just don't like putting numbers on this, but instead of spending 100% of your time over 3 months doing a capital raise, it's spending 25% every month for 12 months. And that still allows the business to continue thriving. That was a good piece of advice. But look, let's move on to sector trends and sustainability. So obviously the report discusses the heightened focus on sustainability and investments. Obviously, it'd be great for you guys to maybe talk a bit about what sustainability is in this context. And after that, how is this emphasis changing the types of startups that are receiving funding?
I don't mind starting. Yeah, so I think if we're going to boil it all down to what investors do, investors are looking to invest in businesses that are going to get them at least probably a 3 to 5 times return in the UK. That's like at a Series A stage. And the way they get the return is by the business growing to a point that when it's sold, there is enough of a market that the business will attract a good offer that means that everyone gets the return that they've been aiming for. So if you're looking at the way that the market sentiment has moved, which businesses are going to be those businesses that are worth the most in 3 to 5 years, as well as being growing, strong businesses, is also the businesses that have a social and economic conscience. So there are, even if you take away the things that I'm not sitting here and saying, look, you need to have solar panels on your building, et cetera, but even having like a strong maternity or paternity policy, things like all those social aspects. Do you care about your employees? And it's not even what are you doing today? It's mapping out what are you doing today and where do you want to be? And what steps are you taking to get there? Because I think that, there's a lot of organizations which are supporting this from like a free point of view. ESG VC is a really strong organization, doing a lot of good content in the space. And all the investors that I've heard, any of their talks or webinars said, all they want to see is a plan. And they can work with you on the plan. They don't expect you to come in with a fully formed ESG policy. They want to know that you do care, and that it is part of your business, your whole business plan. You haven't just put it in because it's something extra that might help you get investment. It has to be core to what you're doing.
Not just chucking in AI and ESG.
Exactly.
and just kind of following up on that as well, it's been trickled down from LP, I think, pressures on GPs as well. So there's now a ESG focus really in place from a top level perspective that GPs have to implement within their particular investments. And obviously it's up to the GP to decide how far along to the right they want to go with that particular theme. So that's why you get a huge amount of funding obviously been put into sustainability and climate, like World Fund, for instance, is one of the largest in the world actually, but certainly Europe, Ada Ventures obviously most recently raising her latest fund to invest in impact. So that there is an increasing importance, I think, right from the very top, not just a base level.
Yeah, I think it's, for me, it'd be great to understand, whether investors are more looking at companies that have an ESG centric approach or whether they're investing into impact companies, right? So impact companies on perhaps climate tech space, or just what have you guys seen in that space? Is it more so focused on general ESG, or are the focused investors just focused on impact, or is it everyone that's more and more focused on impact?
So I don't mind starting on that. I think it's really important to note that there are obviously like specialist funds that invest in either climate or impact, etc. But the more sector agnostic funds, their fundraising strategy is still to get the level of returns that they need.
Yeah.
And a business that isn't growing at the rate of MRR increase or annual increase that they need, or doesn't have the right gross profit or any other KPIs that they need to see to make the investment, just because they might be solving the climate crisis doesn't mean that it's an investable company.
Yeah.
So I think that's really important. Just having an ESG friendly business isn't going to get you investment. It needs to go hand in hand.
Yeah, absolutely. I think just onto that as well. I mean, there's a big toss up really in climate tech now in regards to a hardware or software enabled approach really to tackling problems. And there's a school of thought really on one side that says that reaching net zero goals really by the time frame that's just set out from a regulation point of view, it's just not possible without implementing more hardware related solutions. So that's a big topic of contention. I would say really in this particular market as well. So yeah, it's really important to actually visualize and contextualize whether you're physically imparting some benefit really into the environment from what your product does. I mean, if I see another, with all respect, another carbon accounting credit software platform, I think I might exit out of this game as soon as humanly possible. It's very saturated really in particular subsectors such as that particular subsector. So I think having a truly differentiated approach really to tackling what is the world's, certainly societies, one of the biggest problems right now is pivotal, but it needs to be truly unique. And I think the point of differentiation in that particular sector is more important than anyone in my personal view.
Yeah, I would agree with you on that one. But in regards to, you spoke about ESG, but from an investor's perspective, you mentioned LPs to GPs down, right? How are investors incorporating ESG into their investment decisions? Right. And how should startups adapt their strategy so that they're both incorporating ESG while remaining, let's say, on a growth path that maybe wasn't there prior to the ESG criteria being thought out?
I can say that one first. So just from maybe Adam can follow suit in regards to the lower level. So yeah, I think especially from the more institutional players, so the endowment funds, the European Investment Fund, which is a government institution, they have a mandate really to comply with regulators who the regulator vision is important to LPs because they obviously donate and invest the most amount of money. So like for instance, when you're raising a fund, you have to have an ESG policy really in place to be attractive to those particular individuals now. And that is an ESG policy on ultimately how you run your own business. Everything from like the day-to-day operations of exactly how you would run a business equivalent essentially, but also how to look and view ESG policies within particular businesses. So for instance, it's very rare that you find VCs investing in gambling propositions, in even if it's vaping, for instance, in smoking related products, etc. Anything that can be detrimental really to the health of a consumer or a business is really kind of seen in the eyes of a regulator, but also now an institutional investor, a big no-no. Maybe Adam can speak to the lower level of end user in business.
Yeah, I think that a lot of investors, when they're looking at businesses, are looking at kind of like red flag reporting ESG. So I think that if you carry that out on your own business first before going for a raise and thinking about where an investor might have an issue. So for example, if you're going out and saying we're solving the carbon, or let's say you're in a circular economy business and you're recycling something, and that's for the good of the environment, but the machines that you're using are very power consumptive, and you're not using solar power, then an investor is going to turn around and say, well, it's not really net benefit, so it doesn't really help. So that's a big red flag to an investor. An investor's not going to turn around and say, oh yeah, I'll definitely invest in this because it's solving an issue and the business is growing. Because on the other hand, you're taking away from one hand to give with the other hand. So it's just doing that kind of like red flag reporting in your mind. It's the same with your deck, your financials, and everything. It's just an extra thing that you now need to think about that is core to raising funds.
Yeah. And I think, following on this, there's obviously the report suggests a shift in sector preferences among investors. How do you think this will impact perhaps innovation in less popular sectors, such as, I think in the report, the telecommunications is very low in terms of funds deployed into, right? So what type of impact will that have on less popular sectors?
I can take this one first. I think we're actually quite keen on, dare I say, like the unsexy, overlooked industries that are typically very underfunded from a VC point of view. So the supply of capital is just not there and has not been there historically, and they're very much an untapped resource. So like prime example of this is maybe like shipping or logistics, where there's only been a couple or three unicorns, as opposed to the likes of fintech, where there's been a huge amount more. So I would say, like, I think building a business in a very unsexy sector is actually quite a sexy thing right now, dare I say it. And there are specialist VCs that really can resonate that more well with you, essentially. And it's just about finding and doing your research, or basically speaking to a third party, such as BDO, which can help you map out an investor outreach strategy in order to make that happen. Ultimately, it's about finding, especially to benefit your own valuation and terms that you land on. It's about finding multiple horses in the race, but meeting them all at the same point in terms of the finish line. So creating fear of missing out on your round is another topic that we might come on to, but it's pivotal really in that regard.
Yeah, and I think just to add to that, it's just what's hot today might not be hot tomorrow. So just to echo what Jack said, if you are doing something which really solves a problem and you've got customers that are buying it, investors will invest. It doesn't, obviously you have to be using the best technology that's available to you and doing the best R&D that you can do. But if you think about 2 years ago, when all anyone ever wanted to invest in was Web3 and crypto, those companies find it difficult to raise now, because investors are just like, well, that didn't work, I'm not investing in that anymore. Even if you've got a really good company, if you've used that technology at your core and without it your business doesn't work, you're kind of a bit stuck. So really growing something which solves the problem that you need to solve, as long as the TAM, or the total addressable market of that market, is big enough and you are solving that problem, as Jack said, you'll get investors to invest.
Great. Now let's move on to economic climate and global trends. So how is the current economic climate influencing investor risk appetites as per the report? And in what ways can startups adapt their pitches to appeal to these changing risk profiles? I know we touched upon it earlier a bit, but we could go a bit more detail. That'd be great.
I'm not too sure if we want to cut this one out. I think Adam said it was a bit too vague. I probably might agree, to be honest. I think we might put it in a bit of detail prior to that.
I think that if you just want to ask about, I think it was the second question on inflation and currency, because then we can just talk about valuation and then.
Cool. Just making a note to remove that. Cool. So moving on. How do you guys foresee the impact of global economic trends such as inflation and currency fluctuations or venture capital investment decisions? And to add to that, what measures should startups take to mitigate these macroeconomic risks?
So the main thing that we've seen for inflation is valuation, and there's lots of charts and graphs that people and data that people have brought out to explain that as interest rates go up, valuations go down because the LPs have other places to put their money. So the risk appetite of investors mean that they're not going to do your 20, 30 times revenue multiples. And if you think about, does anyone on this call or anyone really expect interest rates to go back down to 0%? Probably not. So those founders that are sitting there and saying, I'm going to wait till valuations come back, it's just not worth waiting for. If you need the money to grow your business, you go out and try and get the best valuation you can get now. because there's more chance your business will grow with funding than without funding. And if you have to give away a bit more of your business to make that happen, then it's worth it. So I think that the biggest change is how it's affected valuations.
Absolutely. I think in late stage business as well, I think I mentioned this before, but shorter term lending options, which can obviously help with an equity sensitivity point of view. If you don't want to give too much of your business away at what you would see as an unfair valuation to, I think the likes of a few players in the space of Cap Chase, Uncapped, etc. They essentially give a very attractive, I would say, product. And it's obviously no personal guarantees, etc. So it doesn't have the scary headline views as previous loans, available to early stage companies do.
Yeah.
But it's obviously not. It's at the cost of obviously not growing your business as fast as you would with, a fully fledged VC round, which would obviously have a lot more capital available to that particular business.
Of course, there's positives and negatives in every different avenues anyway. So that makes sense. Look, in terms of moving ahead, we'll look at technology, innovation, and future trends. So considering the rapid evolution of the venture landscape, how might the role of traditional VC change in the next 5 years? Obviously, we've seen a lot more funds appear and emerge in the last 5 years. Is this a trend that we're going to continue seeing, or what are you guys seeing?
Yeah, I can take this one. So like I said, I think there's a whole lot more of optionality available really to founders than there used to be historically. Like I said, obviously the short-term debt options being one of them, which has played a pivotal part really in Series A and B companies' growth, at least somewhat. And there are a number of different kind of propositions really out there. I think obviously within this particular, dare I say, downturn of the markets, anything that can mitigate the investors' risk from an instrument point of view, especially, is quite attractive to them. So it's not necessarily an emerging fund model, but it's been around for a while and very much used a lot, especially the earlier stage companies now, is an AFA or a safe equivalent really in the US. They're being really used to accelerate processes and to get around the way of an early stage. Often those, like risk profiles are rewarded with a discount rate. So we see a lot of ASAs which give essentially the investor the right to invest at a valuation set at a later point in time, but with a cap on it. We see a lot of those models emerging and are very, very popular, I would say. I think it's always going to be quite a opaque industry, and filling up, it's not very well innovated industry, to be quite honest, from a funding perspective.
Yeah.
VCs like what they know, and often that's unfortunately to the detriment of founders.
Yeah, but maybe just to keep on that, if possible, how do you maybe see the role of perhaps AI and blockchain coming to, I don't know if this is a word, but de-opaque this industry, right? Yeah.
Yeah, absolutely. I think it's VC's been a pretty pivotal amount of change really with the impact of especially data analytics and AI. It's changed the landscape a lot from a sourcing perspective, especially a huge amount of resources and money is being spent on sourcing. Currently, I think from a top-down perspective, those methods are very, very advanced. So like big thought leaders in this space are like perhaps Andre from Early Bird. I know episode 1 did a huge amount of this as well. And they often play and pick on a characteristic which is most important to them. So Adam rightly said that the only way to de-risk an investment at the earlier stage is belief in the founder, and obviously belief in the founder derives from perhaps previous experiences. Maybe if you're a behavioral investor, maybe it's from the childhood, etc., that they've been raised from. But from a data point of view, it's often where they've worked in the past and at what position, with what level of autonomy, essentially, at the end of the day. And that's given way to models that can source extremely promising talents. So for instance, Mistral AI is a big kind of AI company on everyone's list at the moment. They raised, I think, $120 million, a ridiculously expensive $270 million valuation. And those 4 individuals were previous engineers and product directors at Google. I think yeah, it's pivotally changed. I think the way VC source companies, first and foremost.
Cool. And you talked about how investors put a lot of emphasis on the team, right? On the management team. Are you seeing more of a shift towards the management team in terms of as an investment criteria, or has it always been this way? Is it growing? Is it decreasing? Especially maybe let's consider this current crisis, economic crisis, and the climate we're in.
I could say this one will lead anyway, and then can maybe follow. I think it's just massively dependent on stage, right? I think shift has always been, the focus has always been on management teams at pre-seed and seed, because ultimately there's not a huge amount of data that a VC can base their decision off, an investment decision off. So I think that always has been, always will be the case. I think obviously when you're breaching growth rounds, Series A, B, and C, it's a different story. Obviously the people leading the business is still first and paramount, and the most important factor to consider, but a huge element of traction comes into Series A investors' investment decisions to growth profile of the business. And obviously like the, should we say, market potential, like Adam said, some businesses are just not suited to a venture backable proposition, and often the size is just not there. I think from a team perspective, like I referred to before, it's mostly about the drive, grit, determination, relentlessness of those individuals, about their ability to resonate well with VCs, because ultimately it increases their chances of raising further down the line, and obviously increases the chance of return from a VC perspective. But yeah, I think every single VC approaches the conversation, at least focused on the founders, that they're only put on that earth or this earth to do one thing, and that's essentially to build that business in its entirety.
I think I'll just add that oddly, the importance of the management team has maybe slightly decreased because the importance of the business model has increased. So whilst it is still probably the key factor in why earlier stage investors invest, there is at least one very famous example, which I'm not going to mention for fear of getting into trouble, of a business that raised money just off the back of a serial founder. And that was pre-COVID. And I don't think that business would have become a unicorn as quickly as it did had it started raising now. Because I think that business model would have been scrutinized a bit more. And if you look at that business model now, it didn't when it first got invested in, the most appealing investment KPIs. So I think that whilst it is extremely important, it has always been extremely important, that scale of the importance of your business model versus the importance of the founder has tipped slightly towards the business model. But as Jack says, without a strong management team the investors wants to back and believe in, you're not going to get invested.
Right. So look, perhaps if you guys have a piece of advice for early stage founders who might not have the right background or the right experience that maybe certain investors are looking for, but have a great product and believe in themselves, what should they do to make sure that they are kind of on the same level as other experienced founders, maybe repeat founders? What actions should they take?
I'm more than happy to say this one. So I'm reading a book at the moment, which actually dispels the myth that most, the most successful founders really come from repeat backgrounds. So I think VCs have a predetermined idea that a good deal can come from anywhere, essentially. So they don't necessarily have to be a repeat founder or a Harvard PhD or an Oxbridge candidate to really gain investment. I think to make themselves more appealing is to put themselves on the same playing field as those. So there's a number of initiatives out there, including Focal, obviously, that can help surface those individuals. And our alumni have gone on to raise a huge amount of money, which haven't come from a traditional, should we say, VC investable background. And there are a lot of funds out there, including ADA, for instance, which is an inclusive venture capital fund that invests in people not with the run-of-the-mill background, investment banking, founded a startup when they were 15 and funded it, etc. So I think putting yourself on the same level for initiatives and doing your research into funds to really understand actually what they want and what they look for, I think is pivotal. Not too sure Adam can add to anything on that front.
No, I just think that I wouldn't worry about not having a traditional investable background, because if you do have a business and you've proven that it's growing and you've proven that the actual business is investable, it's about having confidence in yourself that there is a reason that business has got there, and whether it's you or your co-founder, you are doing something right which makes you investable. And I think like sitting there before you go out for a raise and thinking, where are the gaps in my management team? Yeah. Do we have a gap from a financial point of view? Should we consider bringing in a fractional CFO before we do the raise, rather than getting to the raise and investor saying, yeah, I like it, but your finance function is not investable? Yeah. Are there things you can fix before going for a raise?
Yeah, absolutely. And there's actually nothing wrong with that, like showing a bit of humility, but there really isn't, like spotting the gaps in your team that you're not particularly good at. But there's absolutely no shame from an investor point of view in showing that. There just needs to be a level of transparency. And often an investor will be able to separate that of what you do know with that of what you need support on. And obviously that of what you do know and are very good at, you should make your superpower when you investor conversations to make it play to your strengths.
Yeah, I think if an investor can see that humility and that they can work with you to plug those gaps, they're automatically getting a value increase. Yeah. As soon as they invest, which is of massive benefit to them, but also to you as founders.
Great. Look, in terms of timing, we have time for a couple more questions. I think I'll merge a couple of them. Let's take on this technology side. So what role do you see technology playing in streamlining the VC funding process, right? Because based on the report, I think it's like 34% of investments take about 5 or 6 meetings, if some more, some less, right? That's that. And how do you think the increasing use of data analytics and AI and VC will change the way investments are sourced and evaluated? So if we break that down, the evaluation, the sourcing, the evaluation, and then the due diligence, how do you think technology comes into that and streamlines that whole process?
Just from a GP perspective or from a founder perspective, sorry?
From a GP perspective.
Okay, cool. Adam, do you want to go first, or yeah, me too?
Yeah, I think that there'll always be in VC a need for a number of meetings because the investor is backing the founders, they're backing the management team. So that's always going to be important. And the investor, to get comfortable with that, will want to ask questions on areas that they're not happy with. And they'll always have to prepare their investment committee report, their IC paper, and that will need to be thorough enough that gains the IC's backing to make the investment. So I don't think that's going away. I think where things could be made more efficient is maybe a bit through due diligence, in like things like data compilation tools, all these things, which just means that you can be more prepared a bit faster. Do I think that there's going to be versions of AI which can help you put a deck together within the next 5-6 years? I would be surprised if there isn't. If you could take my team's knowledge and build that into an AI platform so that by the time we're reviewing a deck, 80% of it's already done. Yeah, I think that's eminently possible. I'm not a techie, and it's like what I say to most CTOs when I say, "Oh, you surely you can just fix this? It'll be a quick fix." And you can see the look on their face going, "Yeah, it's not going to be that quick." But do I think that those things are eminently possible? Yes. Do I think that you'll eventually be able to feed some assumptions in your management accounts into an AI model, and it will come out with a financial model that's almost fit to go to VCs? Probably, yeah. I think all those things are eminently possible, and it will save time in preparation. But that human contact with VCs is always going to remain important. So the number of meetings, I don't think that will change, but the ability to get the data out to respond to VCs' questions should be able to be sped up.
Yeah, absolutely. I think from a founder perspective, there's a multitude of tools really out there. I mean, we've mentioned Focal. Sorry, it's a bit of a shameless plug, but obviously we're a tech-enabled platform that can help on the sourcing investors side, but also from a VC point of view, sourcing founders side. We're not probably the first to do it, and probably definitely won't be the last. So there's definitely other platforms that founders and also VCs can use to source. From a tracking point of view, I think if you're not going through a third party like Adam, CRM from a kind of point of view, from a tech angle is pivotal important to make sure that you circle round on conversations, to make sure that you are massively on it in terms of chasing, in terms of getting materials back over to the particular VC that they've requested. I think from a funding perspective is particularly an interesting space as well. There's now availability of platforms that can structure investments extremely easily. So we use Odin, which has been around for maybe 3.5, 4 years. And essentially from a VC point of view can help structure syndications, can even now help structure a fund if you're raising a fund as an emerging GP. That can also help a founder. They can basically just go online, enter a few details from a company legal point of view, upload their certificate of incorporation and start a fundraise where they can distribute a link where people can commit, transfer funds, etc. So that kind of closing part is very much streamlined, I think, already with the help of those individuals. Seed legals have obviously been around for an extremely long time, which can help with the documentation front to save you going for a fully fledged law firm, even though perhaps probably in part, especially if you want to get the best possible deal, is probably advisable to at least use a mix of both. I think I mentioned this before, but VCs are quite fickle human beings, so never underestimate the power of really having or putting your best front forward. So there's now pitch deck software which founders can use to help that story really resonates well, that uses AI. I think Canva, for instance, even has an AI tool. We see a lot of decks through that particular platform. Yeah. And then on the kind of sourcing and AI and data analytics side, I think we might have mentioned that before in terms of how VC funds are really honing down on what is critically important to them. And most of the time that is either about talent at the earlier stage or data availability at late stage. And what I mean by that is Series A and B funds are basically just pulling data in from public sources such as Companies House, for instance, which will fit their particular thesis. So have completed a funding round before, their credit rating has changed, the number of shareholders has increased. So yeah, those large language models in particularly clever, I think now, really servicing great companies, and VCs are putting a huge amount of money into investing in those.
Yeah. And I think, one of the things I've done recently is specifically for B2B SaaS, because that's a lot of the companies we see at Wholesale Investor. What I did is, the new Chat GPT module where you can create your own GPT. I uploaded the best B2B SaaS pitch decks based on different VCs, and I've added the top VCs, their investment criteria into B2B SaaS into it. And just to test it, I uploaded our own Wholesale Investors, because we're B2B SaaS, into it. I'm like, can you help with the pitch deck based on all of these criterias? And it spurned something out, which was great. It was fantastic. I
know that Prezi does that as well. It's really impressive.
So you do that with, if you're a fintech company, maybe that's not an easy trick, but it's something that could take you somewhere a bit elevated in terms of the VC, in terms of the pitch deck game. Is probably just make your own GPT with the best decks in your industry and then just go from there.
Absolutely. I think Adam's right there. There's always going to be a human element which is needed, both of course on the VC sourcing side, but also the founder outreach side. I really think that'll ever be fully automated.
Yeah, I think it comes back to the original point, like the point we were making earlier, that the team, especially in early stage, is still the most crucial, right? So I don't think you can remove those face-to-face meetings or just those meetings in general. Look, we have maybe time for one more question. In your opinion, both of you, what is the most underappreciated sector in the VC space currently, and why? And we'll do one more question at the end, which is, or maybe you can incorporate them. What's the one piece of advice, the biggest piece of advice, I know we went on one earlier, but that you would give to founders thinking of starting to raise now?
Do you want to go first, Adam?
I'll take the second bit. Sorry.
No worries.
Yeah, I don't mind combining them. So like the first bit is that I mentioned it before is if you look at the report and you look at the companies that are raising, you look at like people will say ESG, people will say fintech, people will say climate tech, but as Jack said previously, it's not what's hot now. So if you feel like you've got a solution to a problem and you can build a commercially viable business to tackle that problem and gain investment, then go and do it. If the market's big enough, you're strong enough founders, and you know there's a problem with a solution, go for it. Don't worry about what's hot now. I think there's two angles, which is I think why we have worked closely with Focal that is just really important for founders to note, and is one, be prepared as you can, because first impressions count. So if your deck is as tight as it can be, you know your numbers as well as you can, and the model is as tight as it can be, then that's really important. And going out to the right investors with the right message is really important. And getting those warm introductions, as much as we want to democratize and remove and increase the transparency as much as possible, there'll always be that element that VCs see so many opportunities that when they see a friendly name in their inbox, they might be more likely to answer that email. But that doesn't stop you from growing from someone who doesn't have that black book to going out and building their network. A lot of people say, go out, be confident, start writing on LinkedIn, build your network that way, ask people how you can help them, and then they'll want to help you. So, for example, like with what Jack's doing with Focal, what the whole Focal team are doing by saying to investors, we're going to bring you deal flow. Investors are coming and saying, well, we'll be more transparent then. If you're giving something to us, we'll give something to you. So it's just about being helpful. I think the whole early stage funding ecosystem is all about helping each other. And you'll find that if you help people, then people will help you. It is, as much as people might give it a bad name from that point of view, I think that it is a very helpful environment.
I wouldn't really have anything else to add there, to be honest. No, it's so good. I think we kind of addressed the question in terms of the appreciation of sectors as well prior to that too.
All right, fantastic. Well, thank you both for your time today. For everyone watching this, again, in this description is a link to the report, and we'll also be including some other information, which you'll be able to find in the description. But thank you both. Thank you, Adam. Thank you, Jack. It's been a pleasure.
Awesome. Thanks for having us.
So I hope you've enjoyed today's CapitalHQ online investment showcase. As I said, we do our best to bring you a range of innovative speakers and also innovative topics as well that, we don't really see being covered too much in the general marketplace. So our role is to help you build your own investment thesis. And of course, we're fortunate enough to attract a lot of talented people, which we can, provide you with access to via our information. Now, following the session, go and contact everyone, go and network with some of the CEOs that actually featured during the event, contact them through the CapitalHQ app, effectively do a bit of a deeper dive in some of the opportunities that were featured today as well. And as I said at the start of it, if the companies are not relevant for you, they may be relevant for someone in your investor network. So please take the time to do the introduction. I hope you enjoyed the showcase. Enjoy the rest of your day.